and welcome to Capital 2020. My name is Steve Torso. I'm the founder and managing director of Wholesale Investor and Crypt. I'd like to say thank you so much for joining us because today we have an incredible lineup of panelists, keynote speakers, and also companies. In fact, today we have over 15 companies being featured from a range of sectors that are actually quite hot at the moment, which we're excited to take you through. So as a first step, these events don't happen without partners. And for us, everything we do right now is about how to create more visibility and how do we engage more people into this ecosystem. So I'd like to say a big thank you to our partners for this event, Ausbiz TV, who in the last few months have just created credible opportunity and content for investors to get high value information on a daily basis. BMYG, who's our shareholder and partner and been incredibly supportive of the ecosystem and also of us. Investec, who's also a shareholder and also a massive supporter of the emerging company ecosystem. Cake, who's a leading online digital registry who has now become a partner of Wholesale Investor. And we're so excited about the opportunity of how we can make a seamless experience for companies when they're raising money to go from capital raise to also straight through to their digital registry. And also MillionaireAsia, who's a leading events company in Asia that help attract high net worth investors to unique opportunities. So thank you so much to our partners for participating in today's event. So the first step is welcome. Wholesale Investor, everything we do is about how do we create visibility for an innovative emerging company ecosystem. How do we break down the traditional barriers for investors to access these unique types of companies? We're very fortunate that in the last few years, we've built a database of over 30,000 high net worth and professional investors, as well as we work with anywhere from 200 to 300 companies a year actually in this area. Everything we do is about how to create an opportunity for tomorrow. Every email we send, every interaction we make, and every event like this that we hold is really about achieving that mission. And today is no different. What also is important about today, it's also about educating you. It's how can we provide you with the information and insights that you may not receive otherwise outside of this context. So as a part of that, we're going to be having over 15 innovative companies presenting. They range from sectors such as blockchain, and I'm talking about real application use of blockchain that's actually generating revenue. Life science, it's been a fundamental area for us over the last decade, and we've worked with some of the some incredible Australian companies that have gone on to be global success stories actually in this space. In fact, one of the companies presenting has had a share price increase over the last few months of over 230%. So make sure you tune in to find out which company that is. As part of the start, to kick off today's session, I'm actually going to be doing an interview with James Spenceley. James Spenceley, we've been working with James since he was the founder of Vocus Communications. Now, Vocus Communications, when we started working with, we're a 40 mil market cap company. He built that to, at its peak, being worth over $8 billion. To me, he's one of the most impressive entrepreneurs that I've ever had the opportunity to work with. And now he's been working on the investor, on much more proactive on the investor side. And in following James on his Twitter, some of the insights are quite entertaining and quite funny, but also quite insightful. And so my idea is I want you to tap into the mind of James as part of this and how he's thinking about this process. And also he's got a very, very funny Valentine's Day story, which sort of kicked off a whole chain of events for him on his investment decisions. We also have a panel session which features some of Australia's leading venture capitalists. For us, to give you some examples, we've got Justin Lipman, who's an investment director at Equity Venture Partners. We've got Emily Close, who's an investment manager at AirTree. And AirTree have become one of the sort of dominant VCs in Australia and made incredible impact with the investments that they've made in innovation and in science. Alan Jones, who's an entrepreneur investor at M8 Ventures, and also Ellisa Bennett, who's a portfolio analyst at Blackbird, who's also one of the most prominent Australian VCs in the market. We're very appreciative to have them involved, and also what we're excited about is to have their insights on how they're looking at their investments in obviously during this period, but also in a post-COVID-19 environment. So make sure you stay tuned for that. That's going to be closing out the event. And then prior to that, obviously we're going to be featuring all the different companies. Now, the way we've set up the event is really straightforward. We've set this up so that you're most likely viewing this either on YouTube or on a crisp stream page that we've actually set up. We've made it so easy that we've got the schedule of companies which are going to be featured in the order which they're going to be featured. If you would like to ask the panelists, if you'd like to ask the presenter a question or the company a question, you simply need to click on the link which says ask a question. As I said, we did make it really simple. And also you can access their deal room from that as well. So the idea is that you can go straight from the stream page, straight into their deal room and get access to the information while they're actually presenting. And then also you can ask questions as well and get engaged with the discussion. The whole idea about our virtual structure is how can we create more engagement between you as the investor and also the companies that are participating in the presentations. I said they're all happy to hear from you. They're all happy to answer your questions and have discussions about their projects and what they're busy working on. So engaging via CRISP is a super important part of this process. Now, the final part I'll mention before I go into the introduction into James is that how we build this ecosystem is by word of mouth. We're incredibly happy that for today we've had over 1,000 registrations for this event, and also that this is also going to be streamed via Ausbiz TV as well. This is a powerful opportunity for this entire ecosystem to grow. Right now, there's no borders, there's no barriers to entry, there's no, we hold events in Sydney and that have sort of 200, 300 people. Now we're having 1,000, 2,000, 3,000 viewers of these events. This is how we create opportunities far beyond the borders of what we're currently looking at. And we want to do everything possible to attract more people to this ecosystem. A recent study come out by Deloitte Access talked about how innovation is going to be a key driver for jobs going forward, and I'm a big believer of that. In fact, what's been so inspiring for me about this period is that when you get the opportunity to work with founders, is like you're living in a different world. You are dealing with opportunistic people, right, that are optimistic and also absolutely driven to make an impact. And that is what I love about this space, and that's also what drives me to want to create more opportunity. So going forward, we encourage all of you will have 10 to 15 people in your networks that can actually make a difference to the companies that are participating today. I encourage you to send them this link. Send them a link to the video, to the YouTube stream. Send them a link to the CRISP stream page. Invite them to join this event as well, because this is all about building an ecosystem for the future. I would like to say thank you for everyone participating. I hope you enjoy the presentations coming up. And I said, and shortly I'm going to give you a bit of a breakdown as far as each of the different companies and what they're looking to tackle. But as a first step, I want to provide an introduction to James Spenceley. As I said, he's been one of the most inspiring entrepreneurs for me because I've been able to watch his story go from startup to listing on the ASX to successfully exiting a portion of that, and then also going and set up his own investment vehicle, and then now becoming a strong investor. But also, he sits on the board of many venture investments through his own privates, and he gets very active in this space. He's a leading thinker in this area, and he spends all day observing the different trends and taking notes, and then making other people aware about it in his ecosystem. So I genuinely appreciate James taking the time to actually spend with us to help us understand how he's looking at this for an investment opportunity. So for our first session today, we're joined by James Spenceley. For me, who's sort of an entrepreneur that I've been sort of watching over the last 10 years and admiring what he's doing. James is was one of the founders of Vocus Communications. We watched him sort of build that company to a sort of $8 billion, basically from a startup to an $8 billion market cap. Also now sort of is running his own sort of investment firm, and also is a chairman of Airtask, which is probably one of the most sort of well-known sort of platforms sort of in Australia as far as tech businesses and tech success stories. So thanks, James, for coming on.
Absolute pleasure. It's great to be here. Great to be in a virtual session, a virtual environment. Really exciting.
Exactly what we talked about. It's nice how we can go to a couple thousand people this time around than sort of a few hundred people in a room.
Yeah, you're not limited by the amount of coffee.
Exactly. Very true. So look, as a start to this, I said, I'll give you I want to give the context as to how I know you. And then I also said, I've been following you on social media and following your updates. So I think they're sort of quite timely and quite relevant because you've got some quite unique perspectives. So for me, how I got to know James was that we started working with James in 2010. In fact, working with Vocus at that time, I think they were a 30, 40 million market cap. They'd just done a backdoor listing. They were on the ASX. and they'd become a client. And I remember they sent through an announcement, and I can't remember the exact percentage, but they sent through an announcement saying that they just experienced 500 or 5,000% sort of revenue increase. And I was like, wow. And so we distributed that email, and our email just went absolute ballistic, and it actually became the model that we built sort of announcements around based off that. And I watched James grow that business to sort of 8 billion, then starting his own investment group. But what I've really enjoyed is that watching James, not only did he build a successful company, but then he did what most sort of founders do, in that they actually reinvest back into the ecosystem, and then sort of mentor and work with other entrepreneurs in the process of building. So that's my sort of context of sort of knowing James. So just to kick off, obviously we're hosting this session for investors. Our audience is sort of high net worth professional investors from mostly Australia and also Asia. Just give your take on what you're sort of seeing at the moment. And what I'd love to start, one of the areas I'd love to start with is which you sort of posted on Twitter, is your Valentine's Day story, which I think is a good sort of starting point.
Yeah, sure. Look, great starting point, unless you're my wife, but she still talks about that one. One of the things I think as an investor I focus very heavily on is I love being full of risk when markets dictate it. So if you look at market volatility, measured by, say, the VIX, when the market's around 10 or 12 or 14 on the VIX, it's great to be risk on, finding pre-IPO companies, VC companies, building them up, getting them ready for listing, and going really heavily into them in big licks of capital. But equally, I'm not just a one-trick pony in terms of being able to invest in risky companies. I think there's time as an investor where you want to be really risk-averse. And one of the things that I saw back in very, very early Feb was obviously the outbreak of COVID in China, and then saw very quickly in sort of mid-February that had spread to other countries. And you could see how that could become just an enormous problem for the world. And if it did become a problem for the world, we were talking, the cessation of global trade, global travel, countries shutting their borders was the thesis. But yet, markets were trading at all-time highs. So it was Friday the 13th, or 14th, sorry, was Valentine's Day. Had dinner plan with my wife, and I said to her, I don't think this is going to last over the weekend. I think people will come to their senses. The market can't be at all-time highs and volatility at almost all-time lows. So I cancelled the dinner and then stayed up all night selling all my shares and putting puts on and selling futures on the US markets. And then amazingly, Monday opened up and the market was up to an all-time new high again, and managed to exit over those next 2 weeks most of my, if not all of my long equities that weren't escrowed. So it was a great opportunity, and you could see the risk coming, and the market was mispricing that risk. And I think that's one of the key things to really focus on. Markets are terribly inefficient. People will tell you they're forward-looking, they price things in, but I could buy the cheapest of cheap put options for a 5% down on the S&P 500. At a time where COVID was out in the wild, was spreading, and was a very known fact. So, the markets are inefficient.
But there was something like, for me, I definitely didn't respond as fast as what you'd like. I actually held an event on February 26th to February 28th. So for you, what was that trigger point instead of around that Feb 14 time? Like, I obviously noticing those trends, but it must have been something that triggered you. Thought, okay, now is the time to move.
Yeah, it was really Italy. It was seeing, the first case in Italy being reported, and then the 126th case in Italy being reported the next day. And then you think about that and say, well, if it's made it from China to Italy, it's made it from China to everywhere. And we're just not seeing it reported yet. I'm sure the testing isn't in place. And then later on in February, around the time you were holding the conference, we'd seen it break out in the US. And I remember very, very early on, probably 3rd of March, watching CNBC and just absorbing all the news flow. And they had a doctor on who I follow on Twitter. So if you follow me, have a look, and you'll find in the people I follow. And he said he works in an emergency room in New York's largest hospital, and he said they had probably 1,000 people in there with respiratory disorders, pneumonia. Yet they'd only tested 32 people in the entire state for coronavirus. So you could see there it was
the reporting was all out,
And the reporting was all out. Everyone was reporting. No one wanted this to be a crisis. I think there's that human bias that we don't want things to be bad. But the information was there if you pieced it together. and that was, we took that as an opportunity. The S&P was still above 3,000, and we shorted again. Bought 2,800 puts on the S&P 500 again, 3rd of March, and then and covered most of those at around sort of, I think, 2,300. It was phenomenal in the space of 2 or 3 weeks when everyone worked out that it was going to shut down.
Interesting you're thinking around that, because I remember sort of being around mid-March, and I remember there was just cracking through the case of basically having about 100,000 cases, right? And it was just after we started sending our staff home and all that. But before that, I said, you're right, and is that willing and hoping that it doesn't sort of impact us. But when it does, it was obviously a shock to the system. And I think that everyone, from my perspective, I'm really lucky in that I deal with the most optimistic people on the planet, being founders and investors in the private space, right? You literally. So I was curious to see when you started to see that unfold. Firstly, how did you? Obviously, that's what you did in the listed space. Then, how did you start thinking about your sort of private company investments?
Yeah, so one of the things at Airtasker, the first thing I did, when I was worried, was called Tim up, the CEO of Airtasker, and I said, mate, we've got to put a hiring freeze on, because Airtasker is a growth business, hires a lot of people every week. I said, immediately freeze. We've got to have a plan for what happens if we shut down in Australia. So we put together a business plan for what happens if we lost 90% of our revenue. We did that probably in the first few days of March, so well ahead. We'd moved to work from home before almost any other company. Very, very similar for all of the businesses. So it was, even in February, I was hounding them saying, think about this going wrong. Think about what the worst case is. Conserve cash. If you're a cash burning business, conserve cash very hard, and be transparent with the employees, which is one of the things I liked about how we did it. We said to the employees, well, if our revenue drops by X, we're going to have to put everyone on a 4-day week. If it drops by Y, we're actually going to have to make some staff cuts. So we were being transparent to the employees, and being rational and fair with them as well. So I think it was about taking it head on, planning for the worst, and then hoping for the best. Whereas I think a lot of business owners, a lot of investors tend to do the reverse. They tend to, kind of hope for the best, and they don't plan for the worst. I think that was the one thing we got right in the investee companies, was we prepared them very, very quickly for a major downturn in revenue and in burn rates potentially.
And so for everything else that's sort of unfolded now, obviously coronavirus is one part. There's obviously a couple other sort of areas to look at. So when you're looking at the sort of stock market now, what's your thoughts? What's your perspective? And what are you looking at as an investor?
Yeah, I'm very nervous about the stock market. There's an incredibly large disconnect between the economic reality and where the market
30 million unemployed.
Exactly right. Yeah, and I've been, if you follow my tweets, there's a whole slew of them.
Yeah.
We lost in the first 2 weeks of coronavirus job losses. We lost the entire amount lost in the global financial crisis in 24 months, and we lost that in 2 weeks. Yeah. So I mean, the numbers they can't even get them right in the US. So there's somewhere between 30 and 40 million people who are out of a job, and then there's probably another 20 or 30 million people that are down to 4 days a week. There's probably another 20 or 30 million people who've lost their bonuses. So there's some incredible stats there. I mean, we're talking statistics unlike anything except for maybe, and even worse than, the Great Depression. Now, a lot of people will argue that the Fed comes in and fixes that. The Fed can print money, it can loan, and it's been doing that. And it's actually, in a number of ways, fixed a huge amount of problems in the financial system. Businesses weren't able to borrow in the debt markets. They couldn't issue junk bonds. They couldn't issue investment grades. They couldn't even issue short-term 90-day paper. So the Fed fixed that by offering to buy all of that. But what the Fed can't fix, and I think this is the crucial part and what makes me particularly concerned about the market, the Fed can't fix revenue. They can't build, they can't make the business tick over better. They can give you liquidity, they can give you loans, which just makes you take on more debt that you'll probably have to pay back, or a lot of it you will have to pay back. So your actual balance sheet is weaker going into the future, but they can't bring more revenue or more customers in the door. So I like to think of it as the Fed fixing liquidity, just not fixing revenue. And when you've got that many unemployed people, you start to get into this spiral. We can't just bounce back to that, because the unemployed people aren't spending money as they would have if they were in a job. their credit rating is now destroyed because they've only been, or even if they get a job, they won't get credit because they've only been in their job, a week, a month, or whatever, not 2 years to be able to get credit. So their spending power is a lot less, which means businesses won't get that revenue back. If they don't get the revenue back, they don't need to rehire the people. And you can see how this can potentially spiral down and down and down. So that gives me a great deal of concern. But I think what people are focused right now is that fear of missing out.
Yeah.
People think, the stock market's going back up. It was the shortest correction. I don't want to miss out. And for me personally, I have no fear of missing out. If I miss this rally and I preserve my capital, I'm happy. Other people will want to take that risk. But I kind of argue at the moment, you're buying it pre-COVID on the US market.
Very close.
Or very close to it. You're buying at what's around just shy of 6,200 on the Australian market. Your PE in the US, which is a little bit clearer and a bit easier to distinguish, the PE is at the moment trading at 20 times for the S&P 500. And that's typically traded, probably 14 to 15 historically. That is higher than the dot-com bubble where the S&P 500 traded. And the quality of the earnings, what we actually most is at the lowest in history. I think 75% of all S&P 500 companies have withdrawn their guidance. So we don't actually know what the E is. We're just trying to guess them.
On your Twitter, you've said it so many times. It's like, how does this make sense?
Yeah, how does this make sense? We don't know what the E is, but we're timesing it by 20. And in fact, the E is coming up, probably being come up with by the brokers who tend to always overinflate because they don't want to piss the companies off and, they're their customers. So we've got an inflated E times by the highest ever historical since, the internet.com bubble, price to earnings. How does that end? I think that there's a lot of risk out there, and you can see that volatility is still remaining high. So, my view on the world is, if you had a time machine and you went back and talked to yourself in January and you said, by the way, I've only got a minute, I'm going to tell you there's a pandemic coming. We're going to shut down all the travel. We're going to shut down all of the restaurants. We're going to close all the borders around the world. School's going to be home. Everyone's going to be working from home. There's going to be historically high unemployment in most, if not every country in the world. It's basically the world's going to stop. And you've got one question, right, as an investor. Okay, what has the market done? Oh, yeah, it's flat. Right? What would you say to yourself? You say, clearly this is a wind-up. That can't make sense. So when things don't make sense, I tend to get ultra sensitive. And to me, when we were first talking about the coronavirus happening and markets not going down, that didn't make sense. And in the same way, this can't continue. So there will be some level of correction.
And obviously we talked about the US stats. Like, what's your thoughts when you hear, like for me, when I first heard when they gave the first unemployment stats for Australia, I was sort of shaking my head. It's like, it was like, what was it, 6.5% or something like that? It's like, there's no reflection of that in the underemployment fact. And just a simple thing, like we put an ad for 2 business development people and we had like 250 applications. Now you can't tell me that's normal.
No, it's not normal at all. And the interesting point is that the unemployment stats don't include people on JobKeeper.
Yes, interesting.
So you've got to gross it up for JobKeeper. So there's probably closer to 10% unemployment when you say that there's a bunch of people being employed solely because of JobKeeper. Yes. And in most, if not all businesses that I'm involved with, we didn't fire people because of JobKeeper. And then come September when that ends, what's going to happen? So you might see September that ending, unemployment jumps up. Also in September, we finally had all of the millennials draw down their $10,000 out of super. In July, they've spent that. So you've got that money that's coming into the system changing. There's a lot of risk coming into the market around September.
Well, you think about September, October, obviously is sort of normally a nervous month, but the JobKeeper finishing around that sort of September, October period, and then for B2B, often it can be a challenging time around that sort of Christmas period. So you factor in JobKeeper disappearing sort of October, and then you've got to factor in that companies, said obviously retail businesses typically have their boom times around that period, but for sort of B2B businesses, it could be more of a challenging time, that December period. So to me, when I sort of communicate with my team, I don't feel like we will know the real impact of this until at least between that sort of November to February period this year, next year.
Yeah, I think that's right. And people ask me, what level do you short the Aussie or the US market? And the question isn't actually what level do you short it at. The question is when. When do you short it? And I think you've nailed it. You've got earnings season in August in Australia. I think that'll be what I call an of course moment. Well, people keep saying it. It's like, you shut the economy down. Of course your earning numbers are terrible. You shut the economy down. Of course there's mass unemployment. And I think this magic, of course, you can of course it away, right? A problem away, because we inflicted this on ourselves. So it's not going to be the period to June that will be the aha moment, we've got a problem. You're right, it's going to be that fourth quarter. It's going to be, it's third quarter, fourth quarter, where people go, oh crap. And it turns from, of course, to oh crap, because the numbers aren't coming back as quickly as we thought, because there is mass unemployment, because there is the chance of a second wave. People aren't going to restaurants, because you can only go to a restaurant at 50% capacity. So those people who are employed in restaurants don't have jobs, so therefore they can't go spend the money. And we see this, and then we haven't even talked about, virus mutations, which is highly likely. We haven't even talked about the fact that a vaccine, Dr. Fauci in the US is saying a vaccine for a coronavirus can typically only work for between 6 and 9 months, maximum 12 months. That's the efficacy of viruses. Vaccines for coronaviruses. So there's huge risk, and then we haven't talked about trade wars, both Australia and US.
I'll throw in one more, which is just my natural thinking as a founder. I've suddenly become comfortable with my team working from home. I can't tell with restrictions on public transport, I can't say to my team, I need you to come to the office, because I don't want them standing at a bus stop watching 5 buses go past because they can't get on. Nor do I want to have, that sort of, you go into protectionist mode, right? Because it's just much easier, because I've got confidence that they can work from home efficiently, right? Because I've seen it, they've proven it across a 3-month period. And then now it's like, well, for myself as a founder, I've been far more effective. So then you're asking yourself the question, how does this impact commercial real estate? How does this impact? So, for example, I've got there's people I know that are looking to move out of the city now, and they're negotiating with their teams to do that. I'm like, that's interesting. All those are trends that no one's sort of talking about, but they're there.
They're there and they're real. Every business I'm involved with is talking about not renewing the same amount of office space. At Airtasker, we didn't take the extra floor. We're saying, well, why would we, when we've got people working from home? And we're probably going to continue that for the next couple of years at least, maybe permanently. Hot desking is, there's always been trialled a little bit, but will become the norm. So what happens to all of these buildings that are, 50 to 60% levered against? People have borrowed 50 or 60% to buy a commercial office building at a 5% yield, when half of the building's, empty, and half of the building's on, a third of the rent that it used to be on. So, and then you talk about sort of even dividends. We're talking banks aren't issuing dividends. A lot of companies have reduced dividends. So now the retirees aren't getting the money in that they used to. They're not going on the travel cruises, the discretionary spending. So there's huge amounts of risk in the market that, again, we just haven't seen that flow through. People aren't paying their mortgages right now because the banks have given them holidays. Guess when those holidays end? Right around that September time.
Yeah, interesting. Now, look, we've probably sounded negative over the last few minutes, but actually the reality is me and you are probably two of the most optimistic people that you'll come across. So how are you how are you going to be taking advantage of what's happening in Australia? I'd say as a private investor in our area, the venture area, and also in the listed space. What are you doing that's different now?
Yeah, I think in the listed space, I'm still particularly, bearish and out of the market, because I just don't think the risk reward is there for all of the reasons we've just covered off. So I'm staying particularly out of the listed space, which was a space that I played a lot in, because you could actually buy, in the last 2 or 3 years, you could buy listed companies far cheaper than you could private companies, which was bizarre. So you could actually find a $4 million business that had $10 million of turnover, but the public markets had shunned, which was much better than the private business raising at 10 times that. So that trend is reversing a little bit. So I think that there's some really exciting stuff happening in the virtual or in the venture capital side. Businesses are focused more on profitability now rather than expensive growth at all costs. You've seen that from Uber right down. Airtasker has done it. A lot of other businesses done it. We've gone for cash flow positive so that we're self-sustaining, so that we don't have to raise money. You see a lot of that. A lot of businesses have gone in the VC space, have gone into hibernation. Their businesses have been hit so hard that they just say, look, what we're going to do is we're going to pause everything, keep the software, keep a minimal staff to service the few customers, and we get rid of the developers, and then we'll come back to this once we're actually active again, and we can sell to people and go on sales calls and do these types of things.
See, I personally find that interesting, because there's a massive issue in losing momentum, right? It's how do you get back that momentum after going through that period? Because getting talent is definitely not an easy part, and also creating momentum in any business is not an easy part. So that structure is an interesting one for me to see how that plays out.
Yeah, I think it's only for certain business types, but it's more predominant in the venture capital space. If you've got a company that's been burning $200,000 or $300,000 or $400,000 a month, that only has $1 million in the bank, and probably businesses that don't have that, that's not attractive to investors right now. The venture capital businesses that are attractive are probably the ones that are very, very close to cash flow positive or above. So I think the businesses that have limited runway do need to do something to go into hibernation. And I disagree with you a little bit on skills. There's mass unemployment. There's so much hidden unemployment in Australia. Yeah. I think you'd be able to hire particularly well, and probably at lower costs than you were today. So at a minimum, it's a great opportunity to clean some house, get rid of some expensive employees that maybe weren't so great, and then have as you say, the 200 people applying for your business development opportunity and taking a pick, and probably paying them less, in particular. So I think there's some really good and exciting opportunities with VC. I'll couple that with a caveat that you just need to make sure when you're investing in VC at the moment that they can get enough money to cover themselves, because it is one of the things in an economic sort of impact like coronavirus. Venture capital is one of the first things to dry up. So you do want to make sure that companies are funding themselves well, and then they really understand that runway that they're buying themselves. But there is great opportunities and probably a lot of pressure on valuations that were, let's say, probably a little bit stratospherically high in some companies in the past. You talk to someone about their new idea on a placemat, and it was $20 or $30 million as the starting valuation. I mean, we've all experienced that. Yep. So I think there are great businesses out there now that will be fairly priced, that can use a partner and a venture investor, and I think that's what you're looking for, is that sort of unison where there's a fair value for the risk that's being taken, and I think everyone gets on board. So there's been a bit of a cleaning of house, I suppose. And
just as a final sort of comment, like Airtasker is obviously an interesting business. So they've obviously grown incredibly well. They've got a lot of media and just a brilliant business model and business. I imagine you see some interesting trends with that business, and I'd love to sort of understand what you've seen for them over the last sort of 3 months.
Yeah, look, it's been very interesting. We first, when we thought about the possibility of a lockdown in Australia, and very early on, sort of early in March, we were planning like maybe a 90% loss of revenue, and how we would handle that as a business. And we actually only saw 30 odd percent drop in revenue from to the worst week, and then we saw it recover very quickly when everyone was at home. People were getting stuff done because they're around the house. They're noticing the wallpaper. They're noticing the hole in the roof. Whatever it is, they're at home. They can actually get an Airtasker around. More to the point, they can let them in the house because they're home. There was a lot of convenience. So we actually saw the numbers, do pretty well and recover quite well. And then we now see the numbers heading up and getting back to a normalised level. And in fact, but the mix of jobs have changed. There's a lot more things happening around the home than we'd seen before. There's a real shift in the trend. And the other thing we're seeing is a lot of people signing up for Airtasker. People who might have lost their job, people who might be on a 4-day week using the 5th day of the week to do some Airtasker work. So it's a fantastic part and barometer for the economy. But you can actually see it. Australia was never hit anywhere near as hard as the rest of the world in most industries, and that Airtasker was probably a perfect example of that.
Brilliant. Well, James, thank you so much for your time. Really appreciate your insights for today. And obviously, look, hopefully sort of in 6 months' time, we can sort of do this session again and reflect on sort of what the things we were talking about from this and see how it's unfolded.
Fantastic. Whether we got the timing right.
Yeah, true.
Excellent. Thanks so much. Thanks for being involved.
So as I mentioned, we have over 15 companies that are going to be participating today. So what I'm going to do is I'm going to give you a brief summary of some of the companies that are going to be presenting, just so you have a snapshot about what's to come throughout the day. So let's kick off. So one of the 2U Grocer, obviously the area of actually logistics and groceries has become so prominent over the last few months, and they've been set up to take advantage of this as a market. And for them, all the aspects of fresh food and also drinks, they've set up to deliver that directly to consumers. And for me, it's exciting to see their growth in such a unique time. Australian Premier Finance delivers finance that's eligible for consumers throughout Australia. Automotive finance that's for consumers throughout Australia. Blackstone Minerals, an ASX listed company that's got a very high grade Little Gem cobalt gold project in British Columbia. Identiti, right? It's another ASX listed company, but tackling blockchain that makes it easier companies to make and actually receive payments. Kendo, which is an employee-centered application which helps connect management team leaders. And if you think about it, as far as an area which has become more important as we've been working from home, and what's more likely is that's going to be a trend going forward, this becomes much more applicable. Newground Capital, we've been working with Newground for years, and to watch these guys successfully deliver to our investors over and over in terms of returns and also unique opportunities in the real estate space. Really happy to have Daniel back participating in the event. Radiant Aerospace, okay, company actually headquartered in the US. Interestingly, working with one of our previous founders as an investor. This company has created a breakthrough that can allow the creation and operation of horizontal takeoff and landing with reusable space aircraft. Exciting area for me. I always love opportunities like this because I know it sort of taps into the innovation mind. Recce said another company I've been following and working with for years. This company over the last few months, as the markets really started to observe what they're doing and started to take notice. As you listen to James's presentation, you'll really start to understand why. Make sure you check out James from Recce's presentation, as well as check out what his share price has been able to do over the last couple months. SendGold is an award-winning digital gold money platform. Their monthly gold demand has grown 819% since January, to give you an idea. Superdraft said, we've watched Jake and the Superdraft team just hit milestone after milestone after milestone of growth, and it's so exciting to have them on as part of their next round. They're Australia's leading residential design and build platform, and they're now in the process of scaling globally. And said, check out their website, check out Jake's presentation. Love to see their growth of what they've been able to achieve. Vidstep, a next generation video technology designed to complement and integrate with many leading technology software products. And any of you software builders understand that the power of growth that a company has when they can integrate with other providers really makes a difference. And then Weazel, a web-based application allows talented people in hospitality venues such as bars and clubs to actually transact. So now that nightlife is starting to come back again, this once again provides an opportunity for that transaction and engagement with consumers. Now, we obviously have more companies than that participating. This is an incredible session of unique and innovative companies that we've got coming up. Most of these companies are based in Australia, but we've also got international companies being featured. I'd like to welcome our international investors that are coming along for the journey as well. I hope you enjoy the presentations. Over to you, Paula.
Our first presentation today is from Zenio Capital, an unregistered management investment company which allows wholesale investors to invest in their fund. Under strict investment guidelines, Zenio operates within high-growth sectors such as education, IT, healthcare and finance. Here to talk further about this is CEO Ali Kassa.
Good day. My name is Ali Kassa and I am from Zenio Capital Equity Fund, a fund of Zenio Capital Limited. I would like to present to you today Zenio Capital Equity Fund. It is an Australian wholesale private equity fund. The fund invests in a number of sectors by acquiring shares or convertible notes in private companies that operate in areas of financial services, professional services, education, healthcare, and IT. Now, the fund provides a fixed return to investors or to yourselves at 7% per year, and the distribution is done every quarter. Now, the purpose of the fund is to prepare and enable profitable exit for baby boomers and entrepreneurs in general. Now, baby boomers are people that are born from 1946 to 1965, and either they have retired or they're about to retire right now. They form about 5.5 million of the Australian population demographics. As of June 30th last year, 2019, people over age 65 increased by about 125,000, and that represents an increase of about 3% plus. Now, I would like to share with you an interesting survey done by William Buck, which is an accounting company here in Australia. And the survey included about 300 people or 300 business owners across Australia. The survey found that 77% of business owners were looking to exit over the next 10 years. 53% of them were looking to exit in 5 years. But what was more interesting in this study was that 34% of people had some sort of exit plan, and the rest did not. Now, this presents a number of challenges for business owners because there will be a massive oversupply of unprepared and unattractive businesses that will sell at the same time. And what this means is that among others, there will be few businesses sold, not all of them will be sold. Buyers will pick and choose. There will be a reduction in the multiple earnings that they will be able to get from the market. And the period where the business will be sold or will be in market will be probably quite long, or it will take longer to sell a particular business, and the business owners will not be able to realize the potential of their business, and therefore will have less money to deal with or to deal with their retirement needs. Now, what is the solution that we offer to this problem that a large number of baby boomer entrepreneurs will exit? Well, the solution is very simple. We would like to offer a package that consists of cash and supporting services that will go together with investment to prepare the businesses from where they are today to an exit point. And as you can see here in this slide, I have an actual example of a business that when we started to work with this business, it got a score of 38. And then over time, the score improved out of 100. And what that will mean is the higher is the score, the more attractive the business is, and the higher the value of the business is. And essentially, our business model is very simple. We take businesses with low score and therefore low multiple. We inject cash and expertise and increase their readiness score and attractiveness score, and therefore we'll be able to attract a better multiple for these businesses. Now, the process is very simple. We have an existing network of financial planners and accountants who in return have their own customer pool. And people that are within this baby boomer demographic, we will identify them. We will offer the corporate advisory services, which has 4 steps. We do an assessment, we build a plan, and then from there we add value and prepare the business for exit. Now, the assessment is pretty much looking at 8 different drivers. And these drivers, as you can see here, consist a number of interesting dimensions that are useful to buyers. And based on those dimensions, then we score the business throughout the life cycle that we invest in the business. Now, What's so special about Zenio Capital Equity Fund is that we have built a unique capability that consists of cash, software, management support, and IPO or exit for this businesses that we invest in. And the potential that we can see there right now, based on the assumption and based on the statistics that I shared with you, there is about 1.1 trillion enterprise value of private companies that potentially are looking to exit in the next 5 to 10 years. And therefore, we made a very conscious decision to actually participate in this stage of the life cycle of entrepreneurs and the organization. What is our corporate advisory process and the partnerships? So we have actually 4 stages. We identify the target. We do a readiness assessment using the value builder model that I shared with you in the previous slide. We do the due diligence and the investment process. And then from there, we help them identify a growth model and make them ready to exit. Now, the exit could be by helping them to do an initial public offering in a different stock exchange that we have partnerships with. We have our own companies that we have made deals with that are currently public companies that would like to buy these companies, or we potentially help them to actually sell in the open market if the price is better, and therefore we act as a business broker. This gives you an idea of what other services we offer beside the actual Zenio Capital Equity Fund. And the team consists of very diverse and experienced team, myself, Marsha, and John. We've been working together for many years, and we have created a very good working relationship where each one of them plays an active role. Now, what are we looking for? We're looking for investors to participate here. The investors would be able to participate with a minimum investment of 50,000 Australian dollars. As I mentioned earlier, the investment provides a fixed return of 7%, and these returns are distributed quarterly. And with that, I'd like to thank you. And if you have any questions, please get in touch with me during the after this presentation through the CRISP dealer room. Thank you and have a great day.
Thank you, Ali. Up next to present is Weazel Holdings, a unique software platform that allows talented people and hospitality venues, such as bars and clubs, to attract, engage, and transact with potential patrons like never before. Using live video streaming and the ability for patrons to feel the ambience of a venue before stepping inside, Weazel has curated a unique revenue model for their clients. Here to talk further about this is CEO Ben Russian.
Hello and welcome to Weazel. My name is Ben Russian. I am the company's CEO and co-founder. Weazel started in 2017 as an idea for a free app that enabled live streaming. Since then, we have built the product into a monetized app specifically for industry, initially targeting hospitality, but since COVID has now pivoted from hospitality to entertainment, and this presentation will capture both entertainment and hospitality industries and the software benefits to both of those industries. The current problem with doing business on social media across those two industries are, in terms of hospitality, most of the apps that are available to the hospitality industry to conduct business online are apps like Uber Eats and Menulog, and they essentially are designed to take people out of the venue and buy things from home. Pictures and reviews are misleading when you do have review type platforms, and there's no accurate way for venues to connect and measure their marketing strategy, because most of the marketing that venues can do is a passive marketing style. The entertainment industry makes very little revenue from online type sales. In terms of Facebook live streaming and YouTube streaming, you need to be in the top 1% of entertainers around the world to actually generate any sort of decent income out of this. And on top of that, when you do use these platforms, you do lose control of your IP, which is also problematic. So what we did is we worked on trying to develop a solution which enables people in terms of content producers and venue managers to be able to connect live streaming technology with e-commerce capabilities through a social media style fan engagement. How we've done this is basically focused on attracting people to venues, and how we've done this is by creating a map which enables people to find venues via a GPS type locator, seeing and hearing what's going on within the venues in terms of live streaming of the video and audio, so people can get an idea of how the venue feels. And patrons are able to then choose and find venues that meet their needs for that particular evening or afternoon, or when they intend to go out. The app also allows venues to communicate directly with people who follow them. The benefit for venues is they're obviously able to direct market to their consumers. So imagine being able to send a message to a consumer at 5 p.m. on a Friday afternoon when they're about to go out for after work drinks, saying, "We do a 2-for-1. We are in your area. Come here and spend your money and buy now." It's a very powerful tool, being able to talk to someone at the exact time you know they're going to be able to make a purchase in your market. And it gives the users a powerful tool which enables them to decide where they're going out, what promotions are available to them, and what the place looks like before they go there. In terms of entertainers, the main benefit for entertainers we have is that our higher quality audio streaming allows us to take a direct input from a mixer feed, which means our broadcast is at the highest possible internet quality it can be. It's not open mic broadcast. They get paid. They get the majority share of the revenue that they generate through their streams, and they don't lose control of their IP. The way our app works is it works on two interfaces. One is the industry dashboard, which is where venues and content producers connect directly. And this allows them to see how well their streams have done, how many people have purchased them, set prices for stuff, upload specials, provide a content page in terms of basic information and things of that nature. So that's basically their connection to their fan and their management of how they're performing using the app. In terms of the user interface, it works very much like an iOS or Android app, and it allows them to follow, search, purchase, and redeem via the app. So they can jump on their phone, they can follow a band that they can buy a stream, and then they can watch the stream when the stream goes live. We are APRA licensed, and we are not a subscription-based platform. We are a pay-per-use platform. So there's no cost to the user if they're not engaging with the content producers or venues that they follow. As I said, the platform works on those two bases. So we are essentially the payment platform and the software producer. The connection between the content producer and the user is something that we are not involved in. We're not intrusive in terms of that respect. So access to the dashboard is basically all done by the producer, and the message they send to their fans is all done via themselves. Fans don't have to worry about having their data sent out to people who they haven't allowed to communicate with them. So there's a lot of security from that point of view. Competition, as I said earlier, YouTube, Facebook, and Instagram provide streaming services and the ability to upload video. However, the ability to monetize your content is difficult unless you have a hell of a lot of followers. In terms of e-commerce and sales, Yelp, Eventbrite, OpenTable allow people to monetize content and get specials out to their audience. However, they don't have a very good streaming capability, if any at all, that enables people to get an idea of what your venue is like. The market is a big market and getting bigger on the back of COVID, and we believe we're positioned well to benefit from changes that are happening in both industries over the next 12 months. Essentially, how we're going to get to market and onboard venues and users is via industry relationships. We're currently connecting with some key industry features, and we are working very hard with venues to be able to promote in-venue in the initial 12 months to build users and get entertainers to drive their followers onto the platform, because entertainers will be motivated to do this because there is a monetary benefit for them. As you can see in this next slide, the revenue able to be generated on a very basic math problem of category 1 entertainer who has an average ticket price of $115 and would have a 10,000 average concert size, has on average 1.8 million Instagram followers. If they charge 10% of the ticket price, that would work out $11.50 per stream. Their cost of the platform would be 75 cents. A 3% uptake on their follower rate would be 54,000 additional followers, and you can see how the revenue model builds out from there. We have a very, very good team in place. Our team currently are all volunteers and have all invested their own money into the project as such. So everyone who is involved at the minute has skin in the game. Which is a big key asset, because you wouldn't invest in something you didn't believe in. What we need moving forward is 800,000 AUD in capital, which equates to a 15% equity in the company, and we've based this on what our forecast earnings is, peer comparable type platforms, although not much really does compare, and the value of the software we've completed already, because we are now ready to trade. The funds will be used for sales and marketing, purchasing additional hardware to do fixed camera installations in venues, continue to develop additional phases of the software that we have in pre-production, and transition our team into full-time. The next steps for Weazel are to do our market test, which is a 3-city, 90-venue industry test, and begin to build some independent production platforms for the entertainment industry, so we're able to see how we produce and our take-up rate from there. We've already begun discussion with major players in the industry to have continued content production by the end of 2020. So just to recap, the highlights on what we have discussed here is that we're going to be the first to market that connects streaming, e-commerce, and social media for industry. We built and owned the network, so we own the hardware and we own the connection between the hardware and the platform, which is a strong defensible strategy. We're non-intrusive, as in we do not impose editorial limits, and we do not act as a middleman between the client and the consumer. We are simply the software producer to allow our clients to connect with their end users. We obviously allow a huge amount of data collection in terms of marketing data, so venues and entertainers can better know what works and what doesn't. And we are market ready. We'll be launching our market test with entertainers and venues within the next 4 to 6 weeks. Thank you for your time. We hope you want to learn more information about Weazel and hopefully want to invest down the track. So please feel free to contact us via CRISP or our contact details via the Wholesaler Investor Network. Thank you very much.
Thank you, Ben. Next to present is video technology startup Vidstep, a solution designed to complement and integrate with many leading software products. As the power of shared video communications for remote and workplace needs increases, Vidstep, with its simplicity and market demand, is now offering investors an opportunity to jump on board. Here to talk about this further is founder Travis Redding.
Hello and welcome to the Vidstep presentation. I'm Travis Redding, founder of the Vidstep technology. Very exciting opportunity. Vidstep is a next generation video product specifically built for virtual and remote teams. It provides step-by-step how-to micro-training essentially. Our purpose, as with most great technologies, is to make something a lot more effective, yet a lot simpler and cost-effective. What is the problem that we have identified and what are we addressing? Well, if you're in the tech industry at all, I'm sure you'll be aware of the great job management, task management, project management softwares, CRM type products, and that makes virtual and remote teaming very possible and very real. Dealing with the who, what, and when is what those technologies do really well. What's not addressed effectively is how to do it. How do people, they get a task allocated to them or a ticket assigned to them, what do you want them to do and how do you want them to get it done? Now, whether it's in the moment micro-training or support, or it's a fixed process in some way, the only possibility at the moment is to provide online training or remote training, or you use a bit of a clumsy process technology, which really replaces the old antiquated SOPs. So where is that nimble and agile and quick and simple how-to information that you can attach to a ticket in Asana or Jira or something like that, whatever the tools people are using to manage their businesses and teams? So the deep dive on the problem is really with this COVID-19 crisis, this has brought it to a head. Even though the trend has been for remote teaming, many people had to move very quickly to deal with this. And of course, the problem is then you lose control of how people are doing things. You don't see it firsthand. Out the door goes predictability, and there's a lot of variation in the way things are delivered. So to add that extra layer of, okay, this is what I want done, who's going to do it when, but here's how to. That's a huge piece to provide for remote teaming. How does the product work? Essentially, video information comes into the application, the step-by-step overlay gets inputted, links, files, attachments, things like that that are important for the viewer to have are inserted. And importantly, also products can be recognized in video or provided by the person developing the content. So people can source materials, tools, ingredients, whatever they need to complete the task. The video information comes from somewhere, and this is one of our go-to-market strategies, is non-competing integration with key technologies that millions of people are already using to accelerate our growth to market. So inputs from great products such as Zoom and Dropbox and Google Drive, and outputting Vidsteps to attach to tickets in some of the Atlassian suite, Asana, Trello, things like that. So partner integration programs is a huge piece of Vidstep. Our core focus is a SaaS product for business teams. It can also be used for public social sharing as well. The secondary focus is the content subscription. People are really keen to subscribe to industry leaders and influencer content. So if they can share step-by-step information on how to do something, then that's hugely valuable for an audience. And the peripheral focus there is the click-through sales on products, to Amazon or leading department stores, supermarkets, etc. If those products are placed in video and the viewer can access them, then that's a huge value add for the Vidstep product and a huge revenue stream also. The mature business of Vidstep has huge potential, particularly with the volume of users for the technologies that we're integrating with. And integration is a very, very simple matter, which can quickly and easily be addressed. Our sector, purely the instructional sector, it is a great growing niche, very little competition and growing demand. So that is where we really want to be known and extend our reach. Our traction to date, look, we're product ready, we go to market, we've got our first users onboarding now. We also have in the wings a government grant, basically a dollar for dollar matched commercialisation grant available from the Australian government. That's all dependent on the outcome of our capital raise and the quality of the partners we get involved here. The primary growth channel, as I mentioned earlier, is the partner integration. It gives us huge leverage and speed to market. A secondary area that we're focusing on is the advisory. So if people are looking for great software applications, through the Gartner network of software advice, Capterra and GetApp, that gives us a huge global reach in a very short amount of time. Of course, the additional channels you would expect, I mentioned earlier the content, the influencer content, that's something a little bit extra there, but your typical product advertising, the education sector plays a part in this, and traditional marketing, social advertising and media, which we're exceptional at with our experiences in a number of other businesses. Our advisory to date, they've really been instrumental in making sure we built a product that is ready for market and needed in the marketplace, rather than the mistake a lot of technologies make of coming up with some great software, but the market, there really isn't a problem they've identified or addressing. We've done that from day one, and how we can grow and scale very quickly. The ask, we're looking for $1 million or 30% ordinary shares, ideally up to 4 investors in an advisory capacity. It'd be perfect for people who are in the tech industry, influential in the tech space, and really know what they're talking about when it comes to this type of technology. I mentioned the commercialization grant that is matched on the $750,000 amount. $250,000 of the cap base is put aside for management and some legal and that type of thing. $750,000 of the operational budget is the matched grant. The application of funds, please take your time and get through that in our deal room. Our milestones, as I said, we're going to market very quickly with Vidstep, and we're getting some good traction. It's still a great time to get involved early with our technology. The opportunity in summary, software is ready now, we're ready to go. Investment still relatively low cost in comparison to what this will be in future rounds of investment. The potential is huge, and a proven global reach and how to get there, most importantly. And it's the right time, because right now the space of virtual and remote team support is a huge topic. It's a growing space, and it is not changing, it's not going back. All right, that's a bit about Vidstep. Click below to take a look at our deal room and get access for yourself there, and we'll help you out with any further questions. Thanks for watching.
Thank you, Travis. Our next presenter, Australian Premier Finance, or APF, delivers automotive finance to eligible consumers throughout Australia. Their 2 main goals include providing high-quality loans and optimal client service, whilst also continuing their strong trend on delivering steady and high returns for their investors. Here to dive deeper into this opportunity is CEO Jason Allen.
Good morning, welcome. Jason Allen is my name. I am the CEO for Australian Premier Finance, or APF as we're also known. In my industry, we hear very often that time is money. So let's get straight into the presentation and see if we are a good match both now and into the future. A little bit about us. We provide automotive loans to eligible consumers who may or may not have impaired credit histories. We've been doing this now for more than 17 years in our space. We are privately funded with long-term based funding partners. We also have more than 17 years of on-time interest payments to our continuing seed investor lenders. We have paid over $11 million interest over the same period, and we have repaid all principal and interest loans to our exited lenders in accordance with the loan agreements. We are Australian credit licensed. We are a responsible lender with extensive sales channels in existence and a growing demand for retail lending that requires greater capital funding to meet the demand. Now, the problem that we have is obviously we have a greater demand for retail lending in our non-conforming sector. One of our biggest problems in the past has been that as a consumer lender, we are constantly capital hungry, and finding you, our investors, historically has been very difficult for us, and we appreciate that Wholesale Investor has made that process a whole lot easier now. Historically, the cost of borrowing capital for us has been high during a period at which our retail consumers are demanding lower retail lending rates. So as a company, we are tasked to minimise the cost of loan delivery and servicing, and lowering the overall cost of our funding progressively equates to increases in our margins, profits, and lower risk to you, our lender investors. Now, the solution, as we see it, is we want to attract you, and we can evidence that we have over 17 years of successful principal and interest repayments to our existing and exited lenders. We see the market opportunity, and we want to approach that headstrong. We want to increase our products and services to our consumers through our existing channels, and obviously to increase revenue and extend our margins, our profitability, and our market share as a result of doing so. Now, we believe that it's our history that makes us worth your investment consideration. Our product is heavily customer focused. We provide responsible loans secured by the purchased assets through our existing channels. We utilise current and secure digital technologies and processes that provide our consumers and our introducers reliable and quality outcomes. We do that in a niche market space that we have been in for the duration of our company existence. We are in a highly regulatory environment. We are internally and externally audited to remain compliant in that space. At 17 years of providing loans to our customers, we certainly can stand the test of time, and we've displayed that. And I'm happy to say that we are built from the ground up also as a family company. Now, we also have long-term employed credit teams here at APF, and they are also cross-trained in collections and arrears management, which we maintain in-house. Now, the market opportunity, as we see it, is this. ABS reported in 2017 that finance commitments in that year were $35.7 billion. They also reported that 90% of all car sales are arranged through finance. Now, the expectation in 2020 and beyond for us is that commitments are to remain relatively steady, I should say, to that historic data moving forward. We are certainly evidencing that. APF is poised to meet that market expectation with controlled delivery products and services and grow in parallel with the addition of new capital funding, hopefully from you. That will achieve positive outcomes for revenue, for margins, for profits, and of course, your investor and confidence in us in our industry. Now, historically, we have seen new upstart lenders and traditional lenders that have unsuccessfully transacted in this non-conforming automotive space. Their failures have been evidenced by many factors, but the most common one we have seen historically is their exposure to total fall-up of their funding lines by their investor lenders. Now, we believe that our approach to our funding model surpasses that of our competition. It protects the longevity of our operations and protects longer investment returns with lower investment risk to you. Now, our competitors might be large public companies or smaller private lenders. And recently this year, one of the larger companies reported that it services only 3% of the used car market in Australia and estimates a further 5 million Australians are either excluded from or not serviced by traditional lenders in this space. Now, that provides a huge opportunity for growth in our sector. We utilise in our company similar or same digital technologies and processes as our larger competitors. So we are poised to seek out and grow in that untapped space. Now, our growth strategy is quite simple. We intend to release new digital technology service processes very shortly. They are ready to go and tested. We want to introduce new asset classes to attract new numbers of eligible consumers, roll out direct referral programs to automotive dealers themselves in the market space, continue to provide negotiated fixed returns to our lender investors as well. And rolling through the next few years is to review and consolidate that program, establish whether new tranche capital raising is required to meet ongoing demand, and continue to look after our investor lender network. Now, our financials are readily available under an NDA, So if you want to find out more about the intricacies of the financials of the business, I am of belief that at the end of this presentation there is a link that you can click. So please do so, and we can run through those financials with you. Now, there's some information there about the rest of our senior management team and founding directors. Please have a look at who we are and where we've been and where we're going. Currently, our funding is $7.3 million of existing debt funding. We are looking to extend that with new capital up to $10 million at the time moving forward. And our book value, of course, is also available to you under an NDA. So please don't hesitate to contact us. Look, in summary, we believe that it is our history that makes us worthy of your investment consideration. APF is a well-established lender, proven track records of providing investor-lender returns on time, every time. We do seek new capital investors at this time to target the known space available in our sector. Our lending products, our policies, our practices are track proven, and our digital technologies are innovative and they are current, and we're about to roll them out. These are a few of the reasons that we believe that APF is worth consideration of inclusion in your investment strategy and portfolio. So thank you for your time. My details are on the screen in front of you now. Don't hesitate to click the button below, and I look forward to speaking with you soon. Thank you.
Thank you, Jason. Recce Pharmaceuticals is our next presenter. Recce is pioneering the development and commercialization of a new class of synthetic antibiotics designed to address the increasingly urgent global health problem of antibiotic-resistant superbugs. Here to talk further about this is Director James Graham.
Hi, I'm James Graham, Executive Director of Recce Pharmaceuticals Limited. So Recce is commercialising a new class of broad-spectrum antibiotic. It's a new class as it's able to kill gram-positive, gram-negative bacteria and their superbug forms with exactly the same ease with repeated use. Our lead indication is focused on sepsis, septicemia or blood poisoning. It's the #1 most expensive condition treated, double the second most. We have a qualified infectious disease designation awarded by the US FDA. That allows us 10 years of market exclusivity, starting only from time of approval, plus fast-track regulatory designation all the way to there. To my knowledge, we're the only company in the world with that QIDP designation for bacteremia or sepsis, so it really facilitates our development going forwards. Our capital structure, Dr. Graham Melrose is former head of Johnson & Johnson Research, executive director of their board of a decade, and he's a chemist by trade. So he's the inventor of our technology and major shareholder. I'm there at #3. I've invested, well, actually I was the first investor and invested in all capital rounds to date, about $150,000 over the last 12 months. And we have a series of institutional investors, typically hidden behind nominee accounts. We're currently trading at about 75 cents, which is just over 100 million market cap. We've got a good cash position with 4 million here and a little less than that, given that was a historical. And we anticipate another $3 million coming from the R&D rebate of the Australian government in the next couple of months. Good trading range, good trade volume, no debt, wholly own our technology, and set up to tackle opportunities as they present. Our opportunities, really, we look at it from a clinical perspective. We're focused on infectious diseases. We always have been, we always will be. Our primary focus is intravascular applications, so full-blown sepsis, but also pre-sepsis models such as an early UTI infection or a kidney infection, meaning that we can seek to tackle that whole infectious disease mold. And we're right at the end of the preclinical phase, about to start in humans. Our second category, which is also at the end of the preclinicals, is our topical administration. So as a spray-on topical solution, able to treat skin infections, burns, wound infections, and assisting in wound closure when they're challenged by bacterial loads on the outside of those wounds. Longer the wound is open, the more complications. We're also rapidly exploring our viral applications, and in the world of infectious diseases at this moment with COVID, that's a big opportunity, and I'd anticipate there'll be some further disclosures around our antiviral applications in due course. As a technology, we have wonderful capability against other applications, oral for Helicobacter pylori, gonorrhea, by example, a major STD or STI, and I think as an infectious disease business with multiple shots on goal, it's a wonderful time to be in business. Why are we different? Well, we talked earlier about a new class of antibiotic. That's because all classes to date are natural. They're bacteria or they're fungi. You find it in nature at the deepest of caves. Somebody said yesterday they found one in their garden. You cultivate it out and you use it as an antibiotic. The problem is when you've got the antibiotic and you've got the bacteria, that specific lock and key fit that nature has provided no longer works because those bacteria mutate to survive. They always have and they always will. Ours is designed from first principles. It's got a unique mechanism of action, which means it interacts with that bacteria regardless of how it mutates, meaning we're able to work with repeated use, something existing antibiotics can no longer do. We are synthetic, as in we are designed with what we want, not reliant on what's given to us in nature. And that means we have all the pros without the cons of what's given to us, and extraordinary economies when it comes to manufacture. None of that expensive cultivation, none of that toxic waste material, 100% yield in our products. This seeks to be the first new class in over 30 years. Our primary focus is sepsis. It's a major patient population, double the most expensive condition treated, and as an unmet medical need, 1 in 5 or 1 in 3 in hospitals, in fact, die typically in the first 24 hours because there's no treatment specifically for sepsis at this moment. We're about to start on a phase 1 human study here in Australia. It's a healthy study or a study to assess dosing in healthy human patients. 40 persons, costs about $1.4 million. We've got a good cash position to achieve that. And we anticipate first human data coming in the second half of this calendar year, which we're rapidly coming into. This is a snapshot of curative versus preventative. We've shown with MRSA superbug, by example, we outperform the best antibiotic, which is oxacillin in that space. Of course, the tip there is oxacillin, if it was any type of bacteria other than MRSA, would not work. And at a clinical level, that guesswork is the challenge that they have. We work against all. And on the preventative course, seeking to prevent infections ever taking place. The quicker you can have patients in and out after a basic surgery, a knee operation or similar, the better the patient outcome and the less stress on the economy as we know it. Safety studies, we've got a fantastic safety dosing window, somewhere between 10 to 80 folds, depending on the animal species. This is another example in dogs. Here's an example of the pre-sepsis models showing that we can get on top of the UTI infection or kidney infection, ultimately treating both sepsis or the pre-sepsis form to be that infectious disease drug that could be administered on first patient presentation. This is looking at wounds, particularly burns wounds, and this is assisting in reducing that bacterial burden. If we then look at if we look at the previous page where we see wound concentration, in both instances, reducing the infection count, outperform the existing, closing the infection more quickly, outperform the existing. That gives rise to a good drug. Influenza, of course, is a major antiviral challenge at this moment. The reason we chose influenza is it has the closest RNA profile to coronavirus itself, and at 4 days we had a BLOQ, or below limit of quantification. Keep it simple, I think it was a cure. We kill at practical speeds. We don't care how those bacteria mutate. We don't care how the viruses mutate either. We continue to work with repeated use. We don't succumb to that bacterial or viral mutation. An example of it working in E. coli cells after 20 minutes of exposure, they're no longer that balloon-like viable cell. We have a good patent position. We're granted out to November 2035. Manufacturing, curative, preventative, and viral. We wholly own our manufacturing. This is in Sydney's Macquarie Park. We're currently producing to support our phase 1 and phase 2 human clinical purposes. And we're really positioned well. We've got an infectious disease crisis around us. We're an infectious disease company. We have a good position, a cash position to tackle the opportunities that infectious disease crisis represents. And we're steadily at a clinical stage, or steadily moving into a clinical stage, where I anticipate clinical readouts in the near term. Thank you for listening. I'm James Graham at Recce Pharmaceuticals Limited.
Thank you, James. Next to present is Superdraft, Australia's leading residential design and build platform. Superdraft has greatly simplified the design and build process for B2C customers and B2B industry partners using the proprietary technology. Here to describe this opportunity further is founder Jake Robinson.
Good morning, ladies and gentlemen. My name is Jake Robinson. I'm the CEO and co-founder of Superdraft. Superdraft is a leading prop tech investment opportunity. But more specifically, we're a leading architectural design and build platform focused on the residential side of the market, including new homes, renovations, extensions, and developments. We help consumers by coordinating their project from inspiration all the way through to build, and provide them with an easy-to-use app which they can use to track the project the entire way through. We also help architects and builders by connecting them with live projects and helping them with project admin and project coordination as well. So we're a complete project coordination platform servicing both the B2C and the B2B side of the residential design and build market. And we have significant revenue streams on both sides. If you look at the architecture market here in Australia and the USA, you'll find it's highly fragmented and disjointed, especially in the residential sector. There is no major players or platforms operating in the residential architecture market here in Australia, and it's the same in the United States as well. So this places Superdraft in a very exciting position to become the leading design and build platform in Australia and the USA. And with your investment and support, we can capitalize on this amazing opportunity. Superdraft has well and truly proven market validation in Australia. We've generated over 17 million in revenue. We've completed thousands of projects, subscribed hundreds of partners. These are the architects, engineers, and builders. And we've coordinated over $1.2 billion worth of construction value since foundation. Superdraft has already also proven the ability for rapid growth. We've maintained a CAGR of around 63% since foundation. We've proven the ability to grow rapidly as much as 140% per annum when we're focused on growth. And we currently receive around 25,000 unique visitors to our website each and every month. These are people looking to build new homes and do renovations, etc. Recently, due to the coronavirus, we've had to implement very aggressive offensive and defensive measures to counteract the effects of the coronavirus. As you can see from this chart, we've had some amazing growth over the last couple of months from the actions that we've taken. We've actually achieved 50% month-to-month growth. And additional to this, with the federal government just releasing their new stimulus package, we're about to launch the stimulus package, we're expecting to see even further acceleration of our growth in 2020 and 2021, which is obviously a very exciting thing. Our vision is to become the world's leading residential build platform, coordinating hundreds of thousands of custom projects from design all the way through to build. There are many problems for consumers in this space. Because the industry is so fragmented, that fragmentation really affects the consumer's experience. There is no platforms gluing everything together. You'll find it's a very complicated and disjointed process. Projects almost always run over budget in terms of time and money, and there's a real lack of 3D visualization tools as well. For the architects, the designers, and all the suppliers in the industry, there's also a lot of problems, again, because it's so fragmented. These suppliers are all on their own. They're mostly sole traders and small businesses. So they're very good at their primary skill, which is, say, design, but they really lack with all the back-end things that they need to grow their business, such as admin, project coordination, but also winning projects, so sales and marketing. So a lot of problems for the suppliers in this industry. And this brings us to the solution, which is what obviously Superdraft is providing in this space. We're very much on our own in this space as the only true dedicated platform that solves the problems for consumers, but also the partners as well. We match the consumers to the best project team, and we help coordinate them through the entire journey, solving all their fundamental problems. For the partners, we give them live projects, but don't just give them leads, live projects that they can either accept or reject. We also help them with their project admin and project coordination needs as well. So we've realized that the entire residential build industry and all of its suppliers, they actually exist to service the consumer and their building project. This means that consumers sit at the very core of the industry and hold the power in terms of demand for the supply of all the products and services, as you can see from this chart. So considering the residential build industry is at the mercy of the consumer project demand, that means whoever is controlling the flow of projects controls the industry. As you can see in this schematic diagram, the platform attracts all the industry suppliers like a magnet by controlling the consumer projects, shown in green, and guiding those projects from design all the way through to build. So that brings us to Superdraft. What is Superdraft? We're a consumer-focused design and build platform that controls projects from inspiration all the way through to build at scale. And we provide value to and generate revenue from all of the industry suppliers as well. Our primary revenue streams on the consumer side is architectural design and drafting services, where we take an average of around $3,500 per project with a 47% gross profit margin. On the partner side, there's a SaaS model there where we take a couple of $1,000s per annum for subscription at a 90% gross profit margin. We have multiple new downstream upsell revenue streams available with our new platform. As you can see in green, we start the project with inspiration and design, but then we have the ability to upsell all the downstream services as well, because we're now controlling and coordinating these projects all the way through to build and post-build. This means we can essentially double the revenue that we receive per project. We've built custom proprietary technology. There's two main core pieces of technology that we've built. One is our project coordination app, which enables all stakeholders, including the consumer, to have a really good, easy, rich experience for coordinating the project. We've also developed our own proprietary interactive 3D technology, which enables the consumer to have a really immersive, lifelike 3D interactive experience from their mobile, from their website, or an app, or even VR if they want to use a VR headset. This is proprietary technology, and we surveyed the market a few years back, and they told us that they really were wanting and needing a 3D experience rather than just a 2D set of plans. And we're very excited to be able to show you this demonstration if you wanted to have a further look. The residential market in Australia is large, sitting around 55.2 billion per annum, $1.2 billion that's for the residential architecture market, a couple of 100,000 projects per year. It's highly fragmented and without any major players or platforms operating. And we've managed to secure around 0.3% of the Australian market to date. So there's a huge amount of growth ahead for Superdraft. How are we going to achieve a 10x growth over the next 3 years to grow to 3% of the Australian market? This is the residential architecture market, where we'll be generating around $80 million in revenue. There's sort of three phases that we'll use to achieve this growth, to achieve this target. One is to continue to vertically scale by focusing on the architecture services, bringing these projects in the front door. Then phase two is to upsell those services downstream. So the engineering, the surveying, all the way through to build and post-build supplying products. The third way is to increase our partner subscriptions, the SaaS business model, B2B, getting all the suppliers on board. The United States market is also very large, sitting at around 7 billion per annum, 1 million project starts per year. This is the residential architecture market, very much a niche market. If you look at the residential construction market as well, it's around $500 billion a year. This market is highly fragmented and there is no major players or platforms operating. Coming to our investment offer, we are closing out the Series A with $800,000 already secured and the round priced at $9.8 million pre-money. This leaves $1 million remaining on the table for you to co-invest alongside the others already in this round. These funds are being used to accelerate our growth here in the Australian market in 2020 and position our platform for international expansion next year. So around mid-2021, we'll be launching a much larger Series B raise for entry into the USA. And of course, this Series B will be at a much larger valuation. So of course, now is a great time for you to come on board. We have many exit options as well. Exit for an IPO or trade sale is obvious for Superdraft. IPO, because we're a consumer-focused brand, it's very relatable, very tangible. People really enjoy, designing and building renovations in new homes. Also, trade sale, because we're controlling projects at scale in the thousands. Obviously, that's a lot of value, potential value. We're talking billions of dollars of construction value. So there's many downstream product supplier companies that would love to get a hold of those projects. In summary, Superdraft is a proven and validated business model. We've got proprietary platform technologies developed. We're first to market here in Australia. We're ready to continue scaling in Australia and the US. And with your assistance and with your investment assistance, together we can really become that dominant design and build platform in Australia and globally. Thanks very much.
Thank you, Jake. Our next presenter today is Kendo, a leader in the realm of HR tech focused on performance improvement. In a world of automation, technological disruption, and the rise of the contingent worker, Kendo offers a unique employee-centered application, enhancing the employee experience. Here to talk about this further is Executive Chairman Jim McCurley.
The world has changed dramatically. The knowledge and experience you have today will not meet the new requirements and challenges of tomorrow. The digital transformation we thought would take a decade has occurred in a few months. Now, things have changed forever. Adaptive businesses, agile management, the gig economy, remote working, virtual conferencing. As workplaces move from hierarchical structures to organic networks, no one is more invested in your career path than you. In this new world over your career, you will have many roles, which means you'll need to be reskilling continually. There's never been a more vital time to assess your capabilities, devise your growth plan, and create a path focused on meaningful outcomes. Take aim. It is yours to own. And the sense of achievement is the sweetest taste of all. With your plan and a digital handshake with your manager, you're not alone on your journey. Effective teams, people working together, delivering better outcomes, driving greater overall success, and sharing in the rewards. So come on, log on to Kendo and see if we can rock this house.
Hi, I'm Jim McCurley and I'm the Executive Chairman of Kendo. Today I'd like to introduce you to Kendo, explain our product and outline the investment opportunity that we have for you. Kendo utilises the higher level of connectivity that's now available in organisations. Objectives and responsibilities are set and agreed with each individual, and information on performance is gathered, analysed, and that feedback provided back to the individuals. Corporations and organisations have corporate imperatives that must be met. Business plan objectives are cascaded to executives and on to managers using a structured online process with agreed accountabilities and frequent measurement.
To add an objective yourself, first decide whether the objective is a project with discrete tasks to complete or an objective that will have a specific numeric target or budget. Let's start with a project objective. First, describe the outcome to be achieved. Be as specific as possible and start it with a verb, for example, deliver, create, or develop. Give the project a start and due date. Decide whether the project is just the one activity you've already described or whether it has multiple activities you need to complete in order to achieve the overall project. If there are multiple activities, you get to describe each of those and allocate a percentage of the overall project. You can save it and come back to it later to finish off or send your project to your manager for agreement.
Kendo helps individuals determine their aspirations. All individuals establish their role, responsibilities, and a growth plan, which is based on an online assessment of their capabilities.
Here you can create a current role. It's more than a job description, which can be generic and out of date. Think beyond the obvious, not just now, but also what's possible. Agree it with your manager so you're clear up front and there's no ambiguity. First, add a few basic details about the role, like the role title and start date. The role level describes the level of responsibility, impact, and decision-making. The level you choose here will determine the complexity of the skills needed to be successful in the role. The higher the level, the more complex the skills needed. Now you get to choose the skills needed for success in the role. Choose a maximum of 6 and mark whether they're essential or desirable. The description of each skill will depend on the role level you chose earlier, so the skills will be more complex for higher level roles. Later, you'll be able to check your current skill level against these to see where your strengths and growth areas are. When you're done, send your role to your manager for agreement so you're both on the same page. They may agree or suggest changes, and you'll receive an email once they've reviewed it.
Kendo strives to create an aligned autonomy, and it does this by recognising the link between the corporate imperatives on the one hand and individual aspirations on the other. We create the concept of teams as the entity within, and this is where the detailed planning and execution happen. The final step in the Kendo method is the assessment of performance to date, and this is done through regular pulse checks with the dashboard reporting back to each individual, team and manager. This provides an opportunity for developing learning that's related to in the work experience and provides a better ROI on learning overall. Our target market are those organisations that are greenfield sites that are looking to invest in talent management software. Kendo is operating in a very exciting part of the market. HR tech, as part of SaaS, is the highest growing segment. We've got a 1-year plan. We've got one very good existing client, and over the next 12 months, we're looking to acquire between 10 and 30 more clients. In this space, clients are sticky. It's a HR product. It's very important they get the right product, and they are not overly fee sensitive. We're looking to raise $1.5 million, and we're going to use a substantial proportion of this on client acquisition activities. We've got a very experienced management team in place with corporate, HR and technical expertise. Kendo will provide ESIC status for eligible investors, which provides substantial tax benefits. Kendo has been valued at $6 million, and in seeking $1.5 million in new money, that will give 20% of the company to the new investors. Kendo's got several competitive advantages. We are a leading HR tech product with the potential to become a world leader. We've got the technical and commercial proof of concept. We've got an existing ASX client onboarded. The product costs have been substantially spent already, and we've got a strong management team committed to make this business a success. I invite you to come and look at the data room that's available on CRISP, and I'm certainly available to talk to you. Thank you.
Thank you, Jim. Next to present is Grocer. In a world where people at home want to get their food and drink delivered without having to go to the shops, Grocer is offering a unique solution with a touch of personalization and the ability to cover a large range of grocery needs. Here to talk further on the Grocer opportunity is COO Arjuna Vimalasuriya.
Hi, my name's Arj, co-founder of Grocer. We're about to show you a video just about our business, and then after that I'll go through our investor deck. Hope you enjoy it.
Hey mate, how you going, Shane?
Yeah, good, Arj. How are you?
Yeah, good. We've just been flat out now with the, we've got a lot of interest in what we're doing over here, mate. Talk a bit about what we're doing.
Starting of this business was a purchase we did a few years ago now, which was the confectionery side of things. We noticed that from that there was a real desire that people wanted to purchase, were comfortable to purchase food online, which is where we started to talk about the opportunities to grow the business more into groceries and fresh produce. It's been an area that, compared to other products, hasn't really taken off as much as it could do. And I think a lot of that's around trust, so believing that you are getting the best produce. And I think the model that we're looking at can overcome that.
Hi, I'm Aj from To You Grocer. I'm one of the co-founders, and I'm obviously really passionate about what we're doing from an e-commerce point of view, because we're really bringing a paddock to plate experience for our consumers. We source our product directly from our suppliers pretty much as you order. Our stock's only there for 24 hours, so we guarantee quality, freshness, and most of all, it's an authentic product.
Love people to try it. Made a world of difference in terms of time and convenience for our family, as well as the freshness that you receive. We're there for the customer. We're open in receiving feedback, and we take that on board.
I've been with them for over a year now, and it's really straightforward. I basically order whatever I need off my device, and it's very quick and simple, and then it comes to my door and I don't even have to leave the home, and it's great that it's just so fresh.
We've got a really good loyal base of customers, and we've got to a point now that everyone's enjoying a product and saying, oh, this is fantastic.
No one really wants to go to the supermarket anymore and queue up for hours just to get in to get a couple of items. And I think that's really where To You Grocer can make a big difference. We can build that trust with our customers that we will provide them the best quality produce that anyone can supply.
This is going to be the wave of the future, where people can source and get products directly from the primary producer or local supplier, and know the freshness is amazing. The meat's actually prepared almost on the morning and then delivered the next day.
To You Grocers, they're a very easy company to work with. They are great. We get along well. All they're all on about is all about the quality, and that's where they've approached us. We've built a relationship together. We cut to size, we cut to portions. They've got recipe cards, they've got pre-packed small goods that they've just launched as well.
With the current situation, we've adapted our business into moving into small take-home meal options. Using To You Grocers platform allows a wider group of people to be able to access our product that wouldn't normally be able to. I think it's complementary, and it's an ancillary to our business. It doesn't take away from what we do at all.
In terms of investors, I think it's a great opportunity to get in at this time. We're an up-and-coming business, and we're just scratching the surface now.
In terms of the investment, we really want our investors to be part of us and come on the journey. So be one of us, be a customer, enjoy the experience, and at the same time, what more would you want? Invest on something that you buy on a daily basis.
I'd definitely recommend investors to consider them, because I think it's a great opportunity to support some local businesses that are really struggling at times like this. So it's nice to just help local.
Just come on board and enjoy the ride.
Hope you enjoyed our video. Just want to go through the information on our slide deck. The e-commerce food industry has grown over the last 5 years at around about 21%. But more importantly, over the last few months, it's grown by about 70%, obviously due to COVID and the current environment. That's seen a real need for our type of business, where we provide quality, safety, and healthy alternative with minimum handling that consumers can enjoy in the safety of their own house without actually having to leave. Key to To You Grocer is three channels, or three important things. Our range, so we provide a full range of fresh products for all the way from dairy, meat, seafood, and fruit and veg. But more importantly, we provide premium wine and craft beer, which our customers enjoy and value. We work directly with local suppliers and primary producers, and all our meat and fish are free range. And where we can, we'll endeavour to get organic. Thirdly is our channels. We focus clearly on community groups. Again, that's through wine tasting events, partnering with schools, community associations, clubs, not-for-profits and charities by working with them and giving a percentage of all our sales back into those community groups, because they're core to what To You Grocer is, community and local. Health and fitness, we will partner with gyms and associations. So we've partnered with health and fitness clubs to provide curated meal plans for their clients on an exercise regime, so we can deliver that. That's including fruit and veg and proteins. Work with dietitians for people with food intolerances, which include allergies and people with health conditions for weight loss. Come up with meal plans, and obviously a direct B2C channel that people can buy online. So, I mean, we're a unique offering in the sense that, you know, we can be like a Marley Spoon or a Hello Fresh, but at the same time we can provide you a staple, your daily staples, which will be your milk, bread, fruit and veg, beyond your curated meal kits. I suppose the key differentiator in all this is the fact that we have low overheads. We work directly with local and primary producers to make sure that a product is fresh. We keep things, probably we only hold inventory for 36 hours, so it's ultra fresh to the consumer, minimal handling. So it's clean, it's safe, and we don't have bricks and mortar overhead costs, and suppliers are competing to compete for shelf space. They're not having to pay for that premium shelf space. So they enjoy that. They get full value in terms of return on their product, and consumers also get supermarket pricing because we can pass that on. So as key milestones, over the key thing is we've got 1,500 registered customers. We have a run rate of about 120K annually at the moment with little or no marketing, with really good GP. Got a full range of groceries, as I mentioned, including craft beer and premium wines. We had an exclusive, we sold out of 6 pallets of New Zealand Renaissance beer, which we had an exclusive agreement. We've been profitable since August. Trade events and showcasing our products have been really good, and we've had really good traction through there. As I said, we partner with schools and associations, and we've got programs in place going into 2020. And we partner with fitness associations and dietitians, NSV and Miss Spartan in particular. Again, the ambition at the moment in our path to success is to really improve our web portal and our e-commerce side of things in terms of a customer experience point of view, and that's predominantly what our investment is for. Beyond that as well is improve our digital and commercial marketing into our constituency, which is within metropolitan Melbourne, but expand that into other states as well as part of our growth phase, and to get into roughly 2,000 customers, a run rate of 2,000 customers a week at a basket size of 75. And we see fairly conservatively at the end of 12 months from the time of investment to grow to roughly 1,900 customers a week at a basket size of 75, which is a $4.45 million turnover. Beyond that, we expect to have a run rate of 2,000 customers a week ongoing for the next 12 months. I see that to be very conservative, but I think there's a great opportunity there because of our customer base and our reach to be greater than that, but we are projecting conservative figures here. What's on offer? 500K for 20% stake in our business. For people looking to put greater investment on board, we're looking potentially for there's potentially a seat on the board or a directorship to be involved in our business strategically. Roughly it's a 25% return if we hit those conservative numbers. There's an opportunity for IPO or trade sale down the track, which is what we're really striving for potentially. And then parcel sizes are a 25K parcel size, and consortium investment is welcome. That's it from me. Hope you enjoyed the presentation and the video. If there's any further questions, please do not hesitate to get in contact with me. That's all. Thank you very much for your time.
Thank you, Arjuna. Our next presenter today is Blackstone Minerals, a company that is actively exploring mining projects globally. After recent successes, Blackstone Minerals is now conducting feasibility studies and aggressively exploring for its new opportunities. Here to dive deeper into this is Managing Director Scott Williamson.
Hi, I'm Scott Williamson, the Managing Director of Blackstone Minerals, and today we're going to talk about our flagship project, the Tark Bar Nickel PGE project in northern Vietnam, and how we are well positioned to meet the demand of the growing lithium-ion battery industry. So since listing Blackstone back in 2017, we've secured a portfolio of high-quality assets across the globe, focused particularly on battery metals and precious metals. And our key focus at the moment is the Tark Bar Nickel project in northern Vietnam. We believe that this is a world-class nickel sulfide district, and we're now moving this mine back into production. It was a previously operating mine between 2013 and 2016. And we believe that this mine will be back into production and will be able to deliver the key ingredient to the lithium-ion battery, which is the nickel sulfate that we think we can deliver over the coming years. We have a board and management team with a history of corporate and exploration success. And so we have a track record over many years of creating shareholder wealth through good science and good geology and mining development. Just a quick snapshot of our corporate structure. We've tried to keep this nice and tight, 243 million shares on issue, a market cap of around $40 million. We've got cash of $7 million. We've recently had a capital injection from our strategic partner, EcoPro, which we'll talk about. So they paid a 62% premium to market recently. So they're now a major shareholder and they hold 16% of the company. Board and management have a strong position of 17%. We have a very supportive German shareholder in Deutsche Börse. So as discussed, we have a board and management team that has a history over 20 years of exploration success throughout many different jurisdictions across many different commodities. The key, I suppose, partnership being Hamish Halliday and Steve Parsons, who have been working together for 20 years and have a, I suppose, long history of creating shareholder wealth. We've just added a EcoPro representative, Mr. Jung, to the board, and so we have that financial, I suppose, expertise coming from EcoPro, our strategic partner. I suppose it all comes back to Dr. Stuart Owen, our exploration manager, one of the best geologists I've ever worked with, and he's a real key part of unlocking this nickel sulfide district in northern Vietnam. We've also got a project manager, Steve Enor. So he was the vendor of this project and actually built and operated the mine in Vietnam. So he's now part of our team and a really important part of bringing this mine back into production. So this is a snapshot of the lithium-ion battery. Over 40% of the cost of the battery is in the raw materials that go into the cathode, being the nickel and cobalt. Of that cathode, there's a movement towards high nickel content. So the initial lithium-ion battery had a ratio of 1:1:1, which is nickel, cobalt to manganese. And the movement is towards this 8:1:1 ratio, where there will be 8 times more nickel than cobalt and manganese going forward. So nickel is a really key part of the lithium-ion battery. A lot of people don't realise that the lithium-ion battery is actually made of predominantly of nickel and nickel chemical product called the nickel sulfate. This is a quick summary of EcoPro. EcoPro is Korea's largest cathode manufacturer and one of the largest cathode manufacturers in the world. They have a battery metals business. They have a precursor subsidiary. They also have a lithium subsidiary. These two companies come together and they build the EcoPro BM. EcoPro BM builds the cathode, which goes into the lithium-ion battery. And EcoPro has some of the largest battery manufacturers in the world, being Samsung and SK Innovation as their major customers. So we're well placed with one of the most important players in the lithium-ion battery industry today, in being EcoPro. This is a snapshot of what we're trying to achieve. The previous owners built this concentrator and a small underground mine. We've just drilled out this large bandfoot disseminated ore body. We believe it will be an open pit mine. This is a picture of Mount Keith, so we haven't built the open pit mine yet. We believe that we have a similar mining scenario to the Mount Keith nickel sulfide mine in Australia, which is one of the best nickel mines in the world. We have hydro grid power. We have the existing concentrator. So the previous owners sunk $130 million into this project. We're now going to move to the downstream process and build a nickel sulfate plant, which will deliver into the lithium-ion battery industry. LG Chem and VinFast have a $2 billion alliance, and they're looking to build a lithium-ion battery plant in Haiphong, which is the port city nearby. So we're well positioned, a first mover into Vietnam, and we believe one of the best jurisdictions in the world to be manufacturing downstream nickel sulfate. This is a picture of our tenement package. The bandfoot concentrator and disseminated ore body, very centrally located throughout this district. There's 25 massive sulfide vein targets, undrilled, untested. So the previous owners did a lot of good work on the surface. We're now looking underneath the surface with geophysics, and we will, we believe, unlock what will be one of the world's largest or most interesting nickel sulfide districts going around today. Recently, we've intersected massive sulfide at the Ban Chang prospect. So we have the first two holes intersected what looks to be very high-grade nickel sulfide. We believe there will be other elements: copper, cobalt, platinum, palladium, and gold. We're awaiting assays, and we're excited what those numbers might look like. We've got over a kilometre of EM anomalies, so we have our own geophysics crew. We're just walking through this whole district to unlock the geology through EM and continued systematic exploration. So we're pretty excited about what this might deliver at Ban Chang, and then we'll look at the other 24 other targets over the coming months and years. So this is what we're trying to achieve with our downstream processing. So this is the nickel concentrate, which will come from the nickel mine that's already been built. We will put it through a pressure oxidation autoclave to produce this nickel sulfate. This is a tried and tested technology used throughout the mining industry, and this is where EcoPro can really add some expertise as well. So EcoPro have some of the best battery chemical engineers in the world, so they'll, we believe, bring not just the skill set, but also the funding required to build this downstream processing facility. And so this will happen over the next 2 to 3 years. So we have a maiden resource expected in Q3 and a scoping study in the, soon after. Next year, 2021, we'll continue with our studies to reopen the mine and then looking to a decision to mine in 2022. This is a 12 to 18 month build phase. So we're hoping to produce nickel sulfate in 2023. So just in summary, we have an international portfolio of high quality battery and precious metals. We focused on our flagship asset today, which is the South, which we believe is well positioned and is one of Southeast Asia's premier nickel sulfide districts in the Tarkwar Nickel Project, where we will be delivering our maiden resource over the coming months, and we will follow up with very quickly with a scoping study. We believe that is where the market should hopefully wake up to what is a very good investment case. We're well funded to deliver that scoping study, but all the way through to a bankable study. So we're funded for the next 12 to 18 months. But most importantly, we have a team that has done this before. So we have a history over many years of creating shareholder wealth through major discoveries, unlocking world-class districts like we have at Tarkwar, and then creating shareholder wealth through exploration success and moving things back into production or into development. And just to finalise, we'll just quickly look at some of the infrastructure we have here. There's so we have the 450,000 tonne per annum concentrator. So over $130 million has already been sunk by the previous owners of this mine. So that's $130 million that we don't have to find and we won't have to dilute our shareholders with. So we can leverage off this infrastructure and turn this mine back on over the coming 2 to 3 years. We'll use that concentrator then to upgrade to a nickel sulfate through a downstream processing facility. The previous owners actually built a modern mechanised underground mine. We're looking to potentially build a large open pit mine, but this is built to a world-class or an Australian standard. So this is built as if it was in Australia. We've just turned a couple of drill rigs off. We're moving drill rigs away from that large ore body into some of these high-grade massive sulfides. We had a major discovery called the King Cobra discovery recently. We believe that will add high grade from surface over the early years of the mine. So we've got a fully operational camp where we have nearly 100 people on site already through this drilling phase. We have a fully permitted tailings facility which also acts as a water dam. So all of that infrastructure is all there, ready to go, permitted. We have all the equipment in excellent condition, refurbished, and we can turn this mine back on very quickly. We have a store full of critical spares, and if you would like to learn more about Blackstone Minerals, please click on the Crisp Deal Room or the barcode below. And we are very active on social media, so go to your usual channels to keep up to date with Blackstone Minerals. We believe that we're going into a very exciting phase of news flow over the coming months. Thank you for your time.
A blockchain-based platform that makes it easier for companies to make and receive payments. As the only fintech using blockchain to solve the lost-in-transit payment information, Identiti is now extending their offering to wholesale investors. Here to discuss this further is CEO John Raymond.
Hi, my name's John Raymond. I'm the CEO of Identiti, and our ASX code is ID8. And we're a young Australian fintech business headquartered in Sydney with customers and staff in Australia and Hong Kong and prospects in Asia, Europe and the United Kingdom. And we're solving the growing problem that the information required to process and report financial transactions around the world is often inaccurate, incomplete, and in some cases even missing. And it's causing payments to be held up, which means money doesn't get to where it's needed fast enough. It causes more and more regulatory fines to be issued by government regulators, as we've seen recently in Australia with Commonwealth Bank and now Westpac. And in some cases, it helps facilitate financial crime. And this is a snapshot of the landscape today, with increasing financial crime, operating costs, regulatory fines, and an explosion in the volume of data around the world. And I think my favourite stat here came from the IBM Watson report back in 2017, which at the time said 90% of the world's data is only 2 years old. And that kind of exponential growth rate makes it extraordinarily hard for existing technology to keep up. And the problem arises because for the majority of financial institutions around the world, their technology is not new and is often a collection of hundreds of individual systems that don't communicate very well with each other, making it very difficult, if not impossible, to get a single view of all of their transaction level information. And it's an extraordinarily big problem to fix, and it's getting harder and harder to solve as each day passes. And on the left here, you can see why it's difficult: cost, risk, data leaks, etc. And on the right, some real world examples of that. And Mizuho is one of the big 4 banks in Japan, and I've listed that probably because I live there. And whilst I wasn't directly impacted, I certainly heard plenty of stories from friends and staff who were some of the 620,000 people who couldn't access their salaries. And closer to home, you might be familiar with the Commonwealth Bank's program to replace their core banking platform, which cost nearly $1.3 billion, or almost triple the original estimate. So this is how financial institutions, for the most part, are solving the problem today. And it's a manual process with lots of people using the phone, email, and even fax. And they are manually chasing missing information. And in the bottom right-hand corner, you can see some of the risks associated with today's solution. Information is insecure, it's prone to errors, and it's generally a poor customer experience. So Identiti has built a platform called Overlay Plus, which, as the name suggests, sits across the top of a bank's entire technology infrastructure, consolidating data from front, middle, and back office systems, giving them one single view of all of their transaction level information. And critically, we've designed the platform to overlay existing technology so banks can immediately capture the right amount of transaction level information without facing many of the risks that come with replacing existing systems. And these are the specific industry problems we're using Overlay Plus to solve today. And you can see that we're focused on 3 at present, with another 2 in our future roadmap. And it's important to note that we can solve more than one problem with a financial institution and therefore sell more than one license for everyone that we're working with. So firstly, we're helping a global bank here in Australia consolidate transaction information for more than a dozen internal systems to make sure they're correctly reporting to AUSTRAC. Secondly, we're helping a global bank solve the problem that more than 10% of their foreign exchange trades are manually completed after settlement date by sales and operations people that should be doing sales and operations tasks because there's missing information. And thirdly, we're helping another global bank solve the problem that it takes them months and months to open corporate bank accounts because the data being collected on company directors is still manually collected and often through their branch network. And looking to the future, our 4th and 5th products are the game changers for us and for the global banking industry. And number 4 will see us helping some of the banks around the world who are in the SWIFT messaging network comply with the new ISO 20022 messaging standard, which 11,000 banks will have to adopt sometime between next year and 2025. And finally, we're helping solve the global problem that more and more banks, particularly in Africa and Eastern Europe, are being removed from the global correspondent network because they're finding it increasingly difficult to provide the amount of additional information the world wants to see about companies, individuals, and transactions in these perceived high-risk jurisdictions. So our big vision is to help thousands of financial institutions around the world solve these problems quickly, easily, and relatively risk-free, and then join them all together to create a globally connected ecosystem for rich transaction-level information and reduce payment hold-ups, reduce financial crime, reduce regulatory fines, and even use that rich information to help more than 1 billion people around the world access the financial services industry. So how do we generate revenue? Well, we're a software business and we generate revenue by serving enterprise customers through a mixture of delivery, annual recurring and uncapped transaction revenue. And we're in the market quoting fees of $450,000 per year, comprising an annual core platform license fee, an annual product license fee and uncapped transaction fees. That might be 15 cents for a transaction where a bank's sending 100,000 reports to the regulator each month, or it might be $5 per transaction for a bank that has 200 ultra high value payments being held up each month. And as I said earlier, our total addressable market is more than 11,000 banks around the world. And remembering that we're planning to solve more than one problem for each financial institution we're working with, we therefore break even just before 20 customers and become a $100 million annual recurring revenue business at 400. And we'll get there by selling directly to the market ourselves through our key partnerships with other technology companies like R3, which you can see there, which is an enterprise blockchain company headquartered in New York City, building an enterprise ecosystem of more than 300 financial services, insurance and healthcare companies working together to build distributed applications on their core to blockchain. And Symphony, another technology company, with this one providing secure team chat, file sharing and compliance and automation tools to their 400 global customers with 45,000 registered users sharing 60 million messages per month. And whilst we will always be in the market selling our own enterprise through our own enterprise sales team, we're expecting the bulk of our growth to come through our strategic partnerships, which is illustrated here in yellow. So finally, here's why I think Identiti is a promising investment. There is significant value in our planned global network. We are in a strong position for the COVID-19 crisis. We've got a detailed 3-year plan to guide what we're doing each day, and we've got patents pending in multiple global markets for our technology. And we're in a strong pipeline position for both customers and strategic investors as we look to the future. Lastly, and I'm conscious of time, I'd encourage you to go to our investors page at identiti.com, where you can find a little bit more about our investor presentation and our growth strategy, marketing strategy, a wider impact of COVID-19 to our business, and learn more about our competitors, our team, and our capital structure. So thanks very much for listening today. And if you would like some more information, please email us at investors@identiti.com. Thank you.
Thank you, John. Our next presentation today is SendGold, Asia Pacific's award-winning gold as a service platform. Boasting impressive traction, a team with extensive experience and activity in over 13 countries, CEO Jody Stanton will explain how wholesale investors can take part in the SendGold opportunity.
I'm Jody Stanton, CEO of SendGold, and I'd like to start by sharing a 2-minute video clip with you.
Did you know that behind China, Australia is the second largest gold producer in the world? SendGold is Asia Pacific's award-winning digital money platform based on gold, history's most reliable safe haven. SendGold gives you the power to build and transfer your wealth outside of the banks, across borders, and across generations. We are unique in the market. With peer-to-peer transfers, we are relevant in today's sharing economy. With our low cost of gold and 100% ownership model, we can serve the sophisticated investor. And with a world-first open API gold as a service platform, we are taking gold into high-growth sectors, including not only DIY wealth and digital banks, but less price-sensitive markets such as rewards, gaming, and gifting, where our margins are high and our cost of acquisition low. We are live in 13 countries, including the US, India, and China. We have grown over 800% since January, and we are busy launching several gold-as-a-service business customers across the globe. And we are pleased to announce we've recently secured our Australian financial services license. We have growing interest from both strategic investors and business customers around the world. Gold has even outperformed other real assets like Australian property.
There are several ways to invest or buy gold, but we've brought it in the digital age. We've made it simple, low cost, and what we call hyperliquid. You can send gold instantly as a gift or payment, as easily as sending a text message, with physical delivery and card spending coming soon. And this is just the beginning. Your gold is handled in independent, high-security vaults, audited by Bureau Veritas, and insured by Lloyd's of London.
The case for investing in SendGold is now stronger than ever. Australia is the second largest gold producer in the world. Join us now. Take advantage of this opportunity and own a part of SendGold today.
SendGold's bringing gold into the digital age, making it available to everyone, anywhere, instantly, in a world of record debt and low interest rates. Since January, we've increased average transaction volume by 311%. We've increased gold buying by 819%. Gold is unique. It's an investment, it's a hedge, and it's a global standard of wealth. Yet physical gold is not liquid. It's hard to store with transactional friction and no utility. SendGold gives you full control of your wealth through accessibility, instant liquidity, and global peer-to-peer transfers. We build a trusted, secure platform with key leaders in their fields, such as Brinks, Lloyd's of London, Bureau Veritas, LBMA, and Amazon. We are designed for rapid scale and margin expansion. Our world-first gold-as-a-service platform makes us unique in the market. We can take gold into new sectors with new use cases for new customers, distributing through both retail and business partners. Our markets are large and growing. The total gold market exceeds trading volume of the S&P 500. Timing is perfect. Even before COVID, gold had outperformed traditional asset classes on a 10 and 20-year basis. And given the current market turmoil, demand for gold is rising sharply, even as prices continue to rise. The current gold bull run is still young compared to that of 2007. Our 3 apps, iOS, Android, and web, are live in 13 countries, including Australia, US, Hong Kong, India, and China. We've proven market demand organically and built strong unit economics before our large-scale launch. Since January, we've launched a number of things. Gift cards and vouchers, level 2 accounts. You can now buy up to $100,000 at a single transaction with SendGold. We've launched our first gold-as-a-service client in India. And last week, we've launched self-managed super fund accounts. We've also recently appointed Chief Marketing Advisor Maria Loyes. You may know Maria from Volt Bank, but also OzForex, Society One, and Virgin. We're rolling out several gold-as-a-service signed distribution partners, including the world's largest cloud-based loyalty program with blue-chip clients around the world. And last week, we signed on Exoday, Deloitte's list of 50 fastest-growing tech companies in the world. We built something called Gold Rush by SendGold. It's based on Pokemon Go for gold. It's an AI-powered game which drives acquisition costs even lower in our selected markets. Our team is strong with deep domain expertise. We come from Wall Street, Microsoft, US Department of Homeland Security, cognitive artificial intelligence, IBM, and of course, Volt. We built a compliance moat, so we're fully regulated under Australian law and may accept global customers according to our strict AML CTF program. We operate under an Australian financial services license, and we're a designated service with AUSTRAC with a private letter ruling, and we've recently undergone an independent audit. The use of funds is all about driving transaction volume. We're going to grow self-managed super fund accounts in Australia, grow our offshore customer base, launch Gold as a Service partners, and deliver our unique product roadmap, which includes, very excited to announce, global card spend, parent-child accounts, physical gold delivery, kilobar volume discounts, and a multi-currency wallet. Our business model is based on transaction fees and margins. We have a low technology burn rate. We have a low company gold price risk. We have no debt. From external investors, we've raised $4 million. We've received $1 million in R&D tax concessions. We intend to lead this category. We're a high-growth business, scalable, proven, live in 13 countries, growing over 800% since January. We're focused on margin expansion. Our Gold as a Service platform not only supports high growth, but margin expansion in entirely new sectors. Our moats include secure technology platform, compliance, low global gold price, AI-driven customer experience, and banking integration across hundreds of currencies and key payment types. Our timing is good. We're at the beginning of a new global gold bull market with new digital modes of wealth management becoming the norm. We have a strong team with multiple liquidity opportunities, including IPO or acquisition, with a growing number of approaches from offshore acquirers. There's a link to our deal room at the bottom. We hope you're interested in having an extended conversation. We look forward to hearing from you soon.
Presenting next is AUM Biosciences, a company on the forefront of disrupting the drug development process in oncology. AUM has the objective of delivering affordable, targeted drugs across a broad spectrum of cancers. Their innovative process and utilization of smart data gives them the edge needed to compete in the market of drug development. Here to give us insight into this opportunity is CEO Vishal Doshi.
Hello everybody, I'm Vishal Doshi. I'm the founder and CEO of AUM Biosciences. I'm delighted to get an opportunity to give you a preliminary introduction about AUM Biosciences. AUM Biosciences is an oncology-focused clinical stage healthcare company committed to developing targeted cancer therapies. AUM's focus is on early stage development of innovative treatment of cancers prevalent in Asia with the potential to address global markets. AUM's current pipeline includes global rights for 2 first-in-class drugs, AUM-001, MNK inhibitor for leukemia and colorectal cancer, and AUM-302, a targeted multi-kinase inhibitor for neuroblastoma and breast cancer indications. AUM-001 is now phase 2 ready, and AUM-302 has a clear pathway for orphan drug designation. In addition to its existing pipeline, AUM will seek to acquire and develop additional promising small molecule candidates through a targeted deal-making program. We aim to raise additional funds to broaden our portfolio for combinatorial therapies, while moving our first drug to clinical proof of concept to achieve maximum value inflection. The centralized R&D IRR is expected to be 0% in 2020. The big pharma R&D model has 3 major challenges: high cost, low productivity, and all-time low returns. In recent years, the average development cost per drug has increased by 67%, while peak sales have declined by 50%. AUM's solution to tackling this problem is to decentralize and de-risk oncology drug development. AUM is disrupting this space by employing a unique, multifaceted, holistic approach that focuses on acquiring first-in-class oncology small molecules and leveraging proprietary AI technologies to augment clinical decision-making and mandating biomarkers to improve the likelihood of approvals by up to 3 times. Our model was designed specifically to markedly improve the efficiency of risk discharge before the key phase 2 decision point. AUM was founded by industry veterans, supported by a team with over 100 years track record in the drug development industry. As an example, which includes execution and exiting a $145 million private equity project finance model with Recce Pharmaceuticals. This virtual drug development model led to the global commercialization of 3 successes. Lenvima for first-line liver cancer, with a peak sale of approximately $3 billion a year. Eribulin with peak sales of over $500 million a year, and Ontac with peak sales of over $100 million a year. This model achieved a 50% success rate, which is 6 times higher than the industry average of 8% in oncology drug development. This is a snapshot of our team and its extensive expertise. We strongly believe that this reduces the executional risk for our prospective investors. Our model is very unique in the sense that we selectively in-license targeted oncology drug candidates in late preclinical and pre-investigational new drug space, and moving them from late preclinical and phase 1 to proof of concept. The successful candidates will then be out-licensed to global partners for further development and marketing authorization, realizing economic returns for AUM's investors. As you can see in the patient economics, 70% of the world's cancer cases are expected to be from Asia. This creates a huge unmet medical need. As you can see in the investment economics, small molecules presents a huge commercial opportunity with the advent of precision medicine and more targeted therapies. Significant acquisition prices have been paid for successful small molecule drug completing phase 2 in oncology with an average deal value of approximately $2.5 to $2.7 billion. MSD acquired Archeol and Peloton Therapeutics for $2.7 billion and $2.2 billion respectively. Our model is further validated through the existence within the major pharma companies of something very similar of having a model of taking early stage clinical assets, taking them all the way until clinical proof of concept. Examples includes Lilly's Chorus model. We have a very targeted portfolio. Our first drug, AUM001, has unique characteristics which include 7 times higher AUC than our competitors, high selectivity with minimal off-target effect, 4 times longer half-life as compared to our competitors, and a completed phase 1 multiple ascending dose study in healthy volunteers which confirms the safety. The science has been further validated by recent $507 million licensing deal that Pfizer announced with one of our closest competitors in the US. AUM302 is a first-in-class targeted therapy which inhibits 3 kinases. You look at PI3K, PIM, and an mTOR. The novelty of AUM302 is that it kills cancer cells rather than simply slowing the growth or preventing proliferation, like the current PI3K and other treatment approaches which exist. AUM302 is uniquely positioned to address a significant need in cancer treatment, that is treatment resistance. I'm quite pleased to say that AUM001 has been officially partnered with NIAID to be tested in a preclinical setting for a potential treatment option of COVID-19. As you can see from this slide, AUM has already secured a long-term strategic partnership with an AI company. This will really complement our AI needs for the next 3 years. The partnership will also enable us to build on AI-driven sustainable pipeline for up to 5 new first-in-class targets through a proprietary AI platform. We have had a very busy 2019, and we expect that 2020 and 2021 is going to be even more busier, providing some amazing news flow for our existing investors and our prospective investors. We have achieved significant milestones. Some of them include our lead program is now phase 2 ready. We have conducted additional cell line analysis, which provides a clear pathway to an IND amendment for our AUM001 in phase 2. AUM001 has been selected to partner with NIAID to further test our drug in COVID-19. We have secured a 3-year strategic partnership with Cyclica to further advance our AI-based drug discovery and development. We have secured a $10.6 million non-dilutive funding. Further announcements on that will be coming soon. As you can see, we have had some really good milestones that we have achieved in 2019 and 2020, and we really hope to speak to our prospective investors to explore potential investment opportunities with AUM Biosciences. Just to summarize on the key highlights of AUM Biosciences, there are 5 bullet points that could be great key takeaway messages on why AUM Biosciences is a fantastic investment opportunity for you. We have a management with an excellent track record of not only delivering solid executional capabilities, but at the same time exiting and working on good quality science as well. We have a short timeline to a value inflection. We have a diversified portfolio with multiple shots on goal, as we are a portfolio-driven company. We have a strong IP position, and we address a large unmet medical need in colorectal cancer, leukemia, and breast cancer. With that, I'm really excited to have further discussions with our prospective investors who would like to know more about AUM Biosciences. If you would like to know more about AUM Biosciences, please do reach out to us on the CRISP platform in the QR code provided below. Once again, thank you very much for your time today, and we look forward to speaking with you again. Thank you.
Thank you, Vishal. Next to present today is real estate debt and equity partner Newground Capital. Newground invests across multiple real estate sectors, providing investors access to off-market deal flow. Here to discuss this opportunity further is Managing Director Daniel Ayres.
Good afternoon. I'm Daniel Ayres, Managing Partner of Newground Capital Partners. As a minority founding shareholder and Wholesale investor, I've personally known Steve Torso for around 10 years now. And during one of our recent conversations, I was sharing some of our strategies. Steve convinced me that it was something that we should share with the WI network. So today, I'm going to share with you a little about our firm, who we are, what we've done, and in particular, these 2 new investment strategies that we're rather excited about and believe address some of the risks and opportunities in this post-COVID-19 world. So Newground, we're a leading investor and manager of real estate capital solutions focused on Australia's mid-market. Simply put, we invest capital, be it debt or equity, alongside real estate developers and asset owners who require additional capital to improve their returns and ultimately deliver more projects or acquire more assets. We've been operating since 2015 and have closed over 24 financings during that time, resulting in an average gross return of 23.6%. We hold and operate an Australian financial services licence and maintain a very high standard of governance and regulatory compliance. Our executive team has a footprint in the Brisbane, Sydney and Melbourne markets, which is important to note because whilst real estate is a global asset class, it does require local market expertise and networks to generate deal flow and understand market-related risks. From the perspective of an investor, investment manager performance and track record is, or at least should be, a base level expectation. You expect such people to be highly competent and deliver consistent performance. However, in our view, that is simply not enough. Newground has built its business around a partnership approach with our investors, and it's based on a very simple promise. We will tell you the truth, we will communicate, and we will do what we said. Admittedly, it sounds simple, and that's because it is. It's our belief that these core principles, combined with talented and competent people, is what makes a successful investment manager. Our executive team has deep expertise developed working in the field of real estate finance, investment, development, and funds management. Our team has held senior positions in global institutions responsible for multi-billion-dollar portfolios of exposures to real estate for periods of 10 to 20 years. Newground has an independent investment committee whose charter it is to ensure sound investment decisioning in line with client mandates and investment policy. The IC is chaired by Eddie Law, who held the role of Global Head of Real Estate for ANZ Bank up until mid-2018. We regularly appear in the media, and these articles can be viewed on our website at any time. Some recent examples of transactions that Newground's been involved with. This is an example of a residential apartment project located in the outer suburb of Canberra. The sponsor was a local home builder who, despite having secured a substantial number of pre-sales, was unable to secure a construction facility from their relationship bank owing to a change of appetite within the bank's credit team. Newground provided a senior secured and junior secured debt facility, and completion is on track for July of this year. This was a preferred equity facility to assist the acquisition of a blue chip piece of real estate located on St Kilda Road in Melbourne. That investment was around 14 months, and we ended up outperforming our forecast return of by around 400 basis points. The final example was the provision of a senior secured facility to acquire a DA-approved neighbourhood retail centre. The sponsors were unable to secure sufficient pre-commitments to lease and ended up selling the asset on market. Despite the change in strategy, our secured first mortgage position provided a significant buffer to potential loss and resulted in a realised return in excess of the forecast. Now, it's fair to say that we have to kiss a lot of frogs to identify investments that meet our criteria and are worthy of recommending to our IC. This approach means we say no around 20 times more often than we typically say yes, and should provide some comfort to our investors that we are protective as to what investments we are willing to put our name to. Now, there are around 234 different items that make up our deal assessment and due diligence program, and these are some of the most common or high-level items. We certainly don't pretend to know it all and call on the expertise of outside consultants and advisors regularly, many of whom you're familiar with, to sound investment governance and decision-making. So let me now share with you some of the strategies of what we've been thinking and our outlook, taking into account the impacts of COVID-19. We're seeing the early emergence of opportunities where sponsor investors are looking to exit their positions or assets owing to the need for liquidity. We believe this will manifest itself in the opportunity to acquire these exposures or assets on favourable terms below their intrinsic value. Conversely, we also believe an increasing number of investors who are nearing or are in retirement will want to avoid the volatility of the equity markets and seek out investments that are uncorrelated and produce steady income. We spent considerable time in this regard and have come up with two strategies that address these thematics and provide an appropriate risk-return profile at opposing ends of the risk-return spectrum. Newground Real Estate Opportunity Fund. This strategy plays into an opportunity that we're seeing emerge where, as a result of combined regulation and government-imposed lockdown, we are witnessing deals where sponsors have liquidity issues and need to exit existing positions. The project or asset they are wanting to exit is fundamentally sound. The issue is at the sponsor level. They have too much on, they're over-leveraged or under-resourced and need to exit, and will do so for less than the exposure may be worth. A lack of liquidity in the debt finance markets provide opportunities for improved returns for those willing to participate, and investors with existing exposures looking to exit those positions at below par value. The objective of the fund will be to target returns in the 15 to 17% range from a diversified portfolio of exposures. We will invest across the capital structure wherever value can be found. Now, this strategy is best suited to sophisticated and professional investors who are seeking a higher risk return profile. Newground currently has several exposures that will be used as seed assets for the portfolio. By way of an example, a junior secured debt facility against a Coles-anchored neighbourhood centre currently under construction and located in a metro suburb of Brisbane. The centre has over 60% of the gross income secured and is anticipated to be completed in October of 2021. Newground Defensive Income Fund Series. Second strategy is what we call our defensive income strategy, which seeks stable, dependable income generated from assets uncorrelated to the equity markets. We observed during the COVID lockdown a number of assets that continue to operate and pay rent, which we have since reclassed as essential real estate. Let me show you what we mean. Grocery anchored retail. It has been widely reported that the retail sector is in trouble, with some even proclaiming retail is dead. And whilst we would certainly agree that discretionary retail has and will continue to be eroded by online, clearly grocery-anchored, non-discretionary retail is very different. Just think back to the last 3 months of lockdown. How many Coles or Woolworths did you see shut down? How many asked their landlord for rental abatement? None that we're aware of. In fact, these businesses were the only ones that stayed open, some 24 hours a day, 7 days a week, and employed thousands of new staff to cater for that demand. Truly an essential service. Childcare is attractive because of its defensive nature. The vast majority of them continue to operate and received increased financial support from the Australian government. Being an essential service that enables our economy to properly operate makes childcare a logical inclusion for a defensive income strategy. We currently have an asset under due diligence, which is located in a growth corridor north of Brisbane. It will be brand new, valued at around 10 million, and which we expect to be able to generate monthly cash distributions of some 7 to 8% per annum. The strategy will see a series of single asset vehicles provide the opportunity to wholesale investors to co-invest alongside Newground for as little as $100,000. Each trust will own 100% freehold interest in the assets and receive regular income. We regularly seek feedback from our investors to ensure that our promise is being delivered on. And as you can see, these comments are a testament to our team's dedication to deliver for our clients. Accordingly, we invite you to discover the same and encourage you to register your interest if either of these strategies I shared with you was of interest. We anticipate launching these funds in August this year, and based on our discussions with investors to date, we expect they will be strongly subscribed to. Thank you for your interest in us, and I look forward to speaking with you and hopefully welcoming you as a client of Newground.
Thank you, Daniel. Our next presentation today is from Sniip, the mobile-based payment solution providing customers with a simple and secure method of receiving, viewing, and paying their bills. Sniip has allowed this effortless billing process whilst allowing reductions in the printing and postage overheads. Here to talk about this further is CEO and founder Damien Vasta.
Hello and welcome to the presentation on Sniip, the easy way to pay. Sniip has a simple mission: to become the new way that Australians pay and manage their bills. Sniip represents simple mobile payments. We're the fastest and easiest way to pay and manage any bill on a mobile. We're bank and card agnostic. We have a unique consumer focus, and we give that consumer control over the way that they pay and manage their bills. To use Sniip, it's easy. Scan a code or import an email bill from your email account, review that bill, enter the amount, select the source of funds you want to use, and authorise payment. Really quick. There's a problem for consumers at the moment in the Australian market because we don't realise how long we spend paying bills. 74% of our bills are still paid in some manual manner, and that takes up a lot of valuable time. Late payment penalties are still current in our life, and we're missing out on early payment discounts simply because we forget to make payments. And then there's people who are still struggling to make those payments because they don't have available funds. 35% of Australians live paycheck to paycheck. And most importantly, banks and billers have dictated the way that we pay those bills. Why is Sniip a solution? Well, consumers can scan a code and pay their bills using a credit card or a debit card using Sniip in less than 10 seconds. That means bill management and payment is easier. It means that consumers can pay their bills so quickly that billers are getting their money much faster than they normally would. In fact, our direct billers with Sniip are getting paid on average 8.6 days before the due date versus a national average of about 14 days after the due date. And consumers now have the choice in how they pay their bills while they're using Sniip. In terms of the market, it's a large market that we're focused on in Australia. It's a 34% total of the Australian consumer payment market in bills. And 1.85 billion bills are paid each year, worth about $385 billion. And on average, the Australian consumer pays about 8.2 bills each month. the consumer bill payment market is enormous, and Sniip is focused on allowing customers to pay using their preferred payment method, as you can see in this pie chart. Wanting to use Australians are wanting to use debit and credit cards, but in fact, the billers and the banks are not always making that accessible. And if a consumer wants to use those payment sources, they invariably have to go through a very clunky process and pay direct to each individual biller that they have a bill with, which isn't ideal. Sniip has focused on key verticals to access this bill payments market. We have direct biller relationships, including Brisbane City Council and Queensland Urban Utilities in southeast Queensland, which offer scan to pay via the QR code that's printed on their bill. We also offer M-billing for Toowoomba City Council, and also click to pay via the Sunshine Coast Regional Council. So those options are available by direct billers offering those customers that they have relationships with the opportunity to use Sniip directly. We have BPay via Sniip, which is the single biggest change in our business, because we have now opened up every BPay biller to Australian consumers, over 45,000 of them nationally. So any Sniip user can access any bill offering BPay as a payment option and pay with any source of funds that they choose. It's a big change in the Australian bill payments market. We also enable payments via the QR code for charities, so that people who want to donate to a worthy cause and don't have cash on them can scan a code and pay anytime they see the QR code displayed. And we also have a beta version of our Xero Marketplace app, which allows small businesses to offer push notification bill delivery to all of their customers so that they can pay quickly using their mobile. In terms of our current direct billers, we have over 30,000 customers registered, with only those small number of billers in southeast Queensland. We've already processed over 145,000 bill payments worth over $68 million. We also give options for those billers. They can use the QR code printed on their bill, which allows people to scan the paper bill or even a PDF on their screen. We allow them to push the bill directly to the customer via push notification. If they don't have the Sniip app, they get a SMS with a deep link, takes them to the App Store where the bill's waiting for them. And then we also offer Click to Pay, which is a payment option that allows the customer to click a payment button inside the body of the email without even needing to open the bill attachment. BPay via Sniip, as I said, is the single biggest step forward that Sniip has made in its last 12 months of development. Why is this important? It's because Sniip has now become the first non-bank payment option to offer bill payments via the BPay payment network on a mobile device. That means that Sniip users can now access over 45,000 billers. That constitutes about 1.5 million BPay payments every day. It means $25 million worth of monthly payments will be accessible to Sniip users, and it means 16% of all those consumer bill payments that go via the BPay market are now accessible to Sniip users also. And what is most important to this is that for the first time, consumers who want to make a payment using the BPay payment scheme can now use whatever payment method that they would like, whether it's a debit card or credit card, whether it's affiliated with a bank or not. So the choice is now with the customer, and they can actually opt to use, for example, an American Express that gives them access to the loyalty points that they would otherwise get for making a retail purchase. So it's a big value add for a lot of those points hunters. Our BPay via Sniip rollout's pretty clear. We've made it through the payment testing phase. We've now built a payments fraud engine. We've been approved as a BPay PIM or payer institution member, the first of our kind. We now have access to the BPay payments network. We're now rolling that out to new customers, because to date, we've only offered it to existing Sniip users who are used to seeing the Sniip QR code. So it's now about letting them know that anytime they see a BPay biller code and reference number, they can pay that bill. We're now going to embark on a new campaign that's going to offer the awareness of Sniip to all BPay, to all bill payers throughout Australia, where we'll target new customer acquisition. In terms of our competitors, we're very different to what's out there. We're not a peer-to-peer payments platform like PayPal or Osco or even the Beam It. We're not an e-commerce platform like PayPal. or Afterpay. We're not a point of sale payments system. What we are is basically a bill payments platform that competes with the banking apps, allowing people to choose the way that they pay and bring in all of their banking relationships or card relationships into the one payment application. We're an aggregator. So what we do is we bring the payment channel into the same platform as the source of funds that the customer chooses to use. And as I've mentioned, that could be any card from any bank, and we'll include all other payment sources in the future, including the other wallets that are available, including Apple Pay, Google Pay, Android Pay, WeChat and Alipay. mBilling is our unique bill delivery platform that enables people to seamlessly connect the bill delivery to the payment. And as I said, it's now live with Toowoomba Council, where customers or ratepayers receive that bill via a push notification and click on it to make a seamless payment via a 4-digit PIN or face recognition confirmation. So that's how easy it is for someone to receive and pay a bill via mBilling. We're enabling that now via the customer being able to push that bill straight into their app. Our mBilling adoption strategy is through partnerships with Xero, as I mentioned before, adopting BPay View as part of the BPay scheme that we're in now, and also allowing direct billers to push out mBills via registration through our portal so that they can upload a payment file and push out mBills direct to their customers, where they otherwise would have only sent them an email or a paper bill offering payment via a bank transfer, which often results in late payments from customers and poor cash flow for those small businesses. We have full technology and compliance capability. We have built a platform that's scalable using best of breed payment capability and technology engineering. We are built using Google Cloud, and we are capable of increasing our customer volume and transaction volume accordingly. We're also extremely compliant with our payment capability, so that anyone who wants to use Sniip can know that they can load their payment information and it's securely stored for a single purpose, so that they know that technology is storing that payment information securely and never needs to be entered again. So we have built the payment platform that every single bill payer in Australia can access. Thank you very much for listening. I hope you click on the link below to access detail around this presentation, and welcome to Sniip.
Thank you, Damien. Presenting next is MediKane, a growth business selling primarily to the healthcare sector. MediKane operates mainly in the diabetes market and secondarily in the post-operative care market. With IP protection, products on market, and an impressive pipeline of products nearing launch, they are now opening up this opportunity to wholesale investors. Here to discuss this further is CEO Rod Lewis.
MediKane sells natural products for health with specific targeted conditions. The first condition is diabetes, and our main product treats type 2 diabetes primarily, although is relevant for gestational and also pre-diabetes. And today, with the world's concern about viral infection, it has been demonstrated to support the immunity system in our bodies. Second product is post-operative patient care from hospitals, and the third business stream is industrial dietary fibre. Before we talk about how we're growing the business, let's talk about what we're here for today, which is to raise funds. We're raising $2.5 million Australian dollars, primarily focused on the Australian growth program initially, and then ultimately we're expanding overseas, Asia and the US, and then Europe. The targets we've got for the next 12 months are a $10 million turnover, enter the other markets more fully. We're already there to a degree right now, and 15,000 customers. But what is diabetes? Everyone knows about it, but probably most people don't realise it's the 7th leading cause of death globally, and above it is suicide. So it's very significant health problem, and equally importantly, for us anyway, there's no product out there that fully treats diabetes. No drug, no food, no supplement. The drugs that people use today are actually very effective, but they allow the condition to get worse for the majority of people. Over time, people end up with high doses or cocktails of drugs. From a community point of view, the healthcare costs of supporting someone with diabetes is over twice the cost of supporting someone without diabetes. And the death rate for people of infections with diabetes is 3 times higher. Tragic, but it does represent an opportunity, and it's well understood in the diabetes community. Diabetes significantly reduces the quality of life. People don't actually die of diabetes, they die of comorbidities. Cardiovascular disease is significantly higher risk for people with diabetes, and people therefore at risk of heart disease and the associated morbidities. They get impaired renal function, or many people do, and often leading to chronic kidney disease. It's quite a debilitating condition. Mostly caused in full or part by circulation problems. High blood sugars reduces circulation. That causes a range of functions. Erectile dysfunction is a massive driver for people to take natural products. Retinopathy, which is partial blindness or indeed full blindness, it affects 80% of people who have had diabetes for over 20 years out of control, and it's a leading cause of blindness for people above 20 and is associated now with the Baker IDA discovered for both dementia and cancer. Our market is primarily type 2 diabetes, 460 million people in that market today. But importantly, the market outside type 2 and type 1 is pre-diabetes, and the International Diabetes Federation suggests it's probably the same size. Talk about our competitors. We're a natural treatment, and the leading drug is metformin. Again, a very safe drug for most people, mild side effects, if any. It's only applicable over 36% of the community, and ours is applicable for well over 80% of the community. And ours can be happily taken if someone has kidney disease. In fact, it's a positive treatment for kidney disease, whereas metformin is not recommended. Interesting, this HbA1c is the measure people use for determining, doctors use for determining if someone is diabetic. The normal range is up to about 6.8 or 7%, and metformin reduces by about 1%. That's their claim on their science and their packs. So if someone's 8, they take metformin, they'll get to 7. Ours works as well or slightly better than the leading drug. Significant point. We also have a case study, not many in fact, but this is a gentleman that's been on our product now for many, many years. When we first met him, he'd been on diabetic for 15 odd years, slightly more I think, and he was well outside the safe range for blood sugar levels. He went onto our product and almost immediately came back well within the range and remains there today. So it reduced his blood sugar levels as expected. Importantly, though, it also reduced insulin and oral medications. The insulin reduction is very significant because in the US, insulin is not free, and there are many people that can't take any medication because they can't afford it, because our product will help change that in the US and everywhere for that matter. Now let's talk about constipation. It is a major problem. 60% of people who've been into hospital for an operation will be constipated. That number's the same here in the US and most of the Asian countries we've dealt with. And there's 36 million odd admissions in the US and 11 million here, similar to Australia in many of the Asian countries. This is an opportunity for us. Importantly, we did 2 clinical trials on this product at Royal Melbourne Hospital. And importantly, when the patients that were constipated were treated with all of the other normal drugs and treatments, and they were still constipated, 88% of them were freed up after they used our product. And that result was repeated in hospital in New York and one in Chicago. Won't go into the science in any detail, but we've done 3 clinical trials, published peer-reviewed trials, a preclinical trial at Royal North Shore, 3 patents, and extensive university work on how the product works in the body, critical when you're selling to the medical world. In terms of sales, we've had doubling of sales for each of the last several years. And for every dollar we invest in the market, we get $5 back, or $5.20 according to this. Our target is a bit over 6 in the next 12 months. Importantly, 40% of the people that try our product once repeat buy it, in fact become usually subscription purchases. The average last year was $482 per customer per year. Our targets are quite significant and achievable. Important, why are they achievable? We've got a lot of data behind it we can talk about, but no product treats diabetes. Viral infections are massively important, and people are now starting to use preventative treatments. And in the industrial target market, we have a superior product priced well within the pricing band. Importantly, all of these projections require penetrations, market penetration less than 1%. So why think about MediKane? We're the only fully effective diabetes treatment in the world. Customers stick to us quite highly. We've got a very effective constipation treatment, 3 published clinical trials. The markets are all significant. They're all growing quite fast. And we've got experience now in each of these 3 markets for 10 years in most of them. Market penetrations are low, margins are high, and the entire business is scalable. If you want more information, please, we can communicate with each other via the Crisp Deal Room, and please make contact via that if you're interested. We'd love to talk to you. Thank you.
And now we will move to the panel session. The session will cover investment trends and themes during and post-COVID-19. Please welcome our panel of experts. Emily Close from AirTree, Ellisa Bennett from Blackbird Ventures, Justin Lipman from Equity Venture Partners, Alan Jones, General Partner at M8 Ventures, and Kylie Merritt, the founder of Ausbiz, will moderate the panel.
Hello everyone, welcome to the Zoom cast. If we can just start, I might get you to go around just quickly and introduce yourselves. Tell us where you're from. Alan, we might start with you.
Hi Kylie, thanks for having me. My name is Alan Jones. I'm now officially the last surviving Alan Jones. The other has retired. Yay, I win. I'm an influencer. I come from the tech startup industry as a founder myself, and lately I've been aspiring to become a cast. I work with accelerator stage startups in Australia and New Zealand.
Okay, Emily.
Hi there, I'm Emily Close. I'm an investment manager on the investment team at AirTree Ventures. We're one of the largest venture funds in ANZ. We have just over $500 million under management now across 3 funds, and I focus on investing in early stage startups.
Great. Justin, hello.
Hey Kylie, and hey everyone, thanks very much for having me virtually here. I'm Justin, I work at Equity Venture Partners, or EVP. We have $70 million under management, invested across around 30 portfolio companies, early stage tech investing with a focus on software opportunities. Great to be here.
Excellent. And Ellisa.
Hi, my name is Ellisa Bennett. I'm in the investments team at Blackbird Ventures. We were established in 2012 with the sole purpose of supercharging Australia's best founders.
Wonderful. Okay, well, let's get into it. Alan, I might start with you. I just want to get a sense, if I can, from you of where you sort of think that the startup ecosystem is at the moment in terms of, you know, the recovery from COVID.
So I think in terms of running the business day to day, a lot of startups haven't really been materially affected and may have even become more productive during lockdown, because a lot of people working in the tech industry actually are a little bit reclusive and rather not be interrupted by co-workers all the time. So for those of us mostly working from a laptop, building code, designing products, that's been helpful. Another category of startups are those people who still need to be selling face-to-face to customers. So those people with a B2C offering, perhaps, or maybe selling into enterprise, they have seen their business significantly disrupted because in time of risk, larger organizations are perhaps less likely to buy from brands that they don't know so well. So I've seen kind of bifurcation. The startups who sell B2C, in some cases, are doing stronger than ever before. In many other cases in the B2B space, it's been much, much more challenging than ever before. So everybody's moving forward in terms of engaging with customers. And then the third question is those startups who happen to be in a funding situation, if they are venture backed, then if they're in a funding situation where they were counting on raising in the next couple of months to sort of 6 months, then suddenly it's been a question of, well, how do we extend our runway to get past this period of uncertainty? Because it seems like investors are slowing down and being more cautious about their investment decisions. But those people who had just closed around and perhaps raised enough for a couple of years of runway, then they're okay for now and probably will make it through okay.
Yeah. Emily, what are you seeing in your sort of portfolio companies? Are there any sort of themes or trends about how people have coped with this situation?
Yeah, I think it's been pretty interesting in terms of the tech sector, but has been impacted in a manner of different ways. And I think you can see that in how it's impacted our portfolio. So you can kind of see a part of our portfolio has acceleration has been a thing in terms of increased adoption of their products. And we've seen that across healthcare. So we have a company called HotDoc that actually won the sort of the fever clinic contract and enabling the government to actually allow patients to come and book in to see fever clinics. We've seen that in education. So we've got companies who are sort of enabling online learning resources for teachers. And we've seen that in sort of e-commerce, and it's really changed purchasing decisions. And people who would normally purchase online have actually been much more comfortable in sort of purchasing things like furniture or pet foods. And so those kind of companies in our portfolio, acceleration has been a thing. There's been a big part of our portfolio too where it's really just remained steady. A large part of our portfolio is enterprise software, and those companies have built really mission critical products for those customers, and they're actually making businesses more efficient digitally. So those companies have kind of remained steady. We haven't seen as much churn. And then there has been a part of our portfolio where it has been challenging, and this has largely been in areas where sort of revenue is driven by in-person events. So things like fashion rental or sort of a photography booking marketplace. It's been challenging for those companies, but we're starting to see green shoots of demand return as the economy and restrictions start to lift. But I think where the uncertainty continues to remain is in companies that sort of we've invested in that are exposed to travel sectors. And I think that's one of the sort of more challenging sectors to navigate how the next few months sort of will look. So I'd say, technology and our portfolio, the impact has been very varied.
Justin, the tech sector in general and your investments, your portfolio companies, how do you sense, or where do you sense they sort of are in the recovery? Or do you think across the board they've kind of, I guess, done better than, the general business population?
Yeah, it's an interesting question. I think, certainly the health effects of the crisis, somehow Australia seems to have sidestepped it, whether by fortune or management. But I think some of the economic sort of impacts might be a little bit sort of more medium term or longer term to play out. But I think, to sort of echo what Alan and Emily were saying, the startup ecosystem is somewhat immune, certainly in our sort of focus in B2B software. We've seen a bunch of companies where, as Emily said, they sell software that becomes mission critical. Their end customers totally rely on it as core and to their sort of fundamental way of operating. And as such, interestingly, I mean, there's a great quote from one of the founders of Vista Equity, which is a big US private equity fund, where the founder says software revenue is actually in some instances safer than first ranking debt. And that's certainly something that we've seen play out a bit in our portfolio. And to the extent that we're really focused on B2B software opportunities, the way that they monetize their products is by way of long-term contracted subscription revenue stream. So it's almost like annuity style income to some degree. So really sort of short-term, macro dislocations, if you like, are somewhat mitigated, or the effect is somewhat mitigated against these startups. I think maybe just another thing to touch on as well, other than simply sort of the economic models of the company, also relates to the trends that most software or sort of venture investors are looking to play into. So, you know, we've been talking about telemedicine and video and remote work for you know, decades, to be honest. And, you know, no one really predicts exogenous effects that accelerates that trend, you know, overnight. But nevertheless, as venture investors, you try to position yourself at the beginning of that wave of digital transformation and playing into those long-term tailwinds. And I think for most startups, to be honest, you know, you think of what's happened in telemedicine, remote education and the like, they're typically well positioned to benefit from the acceleration of that arc of digital transformation and the opposite. So I think as compared to the general business community, if anything, you know, the Australian startup ecosystem is probably in a good spot, to be honest.
I guess the question that comes out of that then is, you know, if it's a sector or a company, you know, like telehealth, obviously a huge boom out of this, but is that sustainable? I mean, you know, just because right now and for the past few months, there's been huge demand for companies which can facilitate telehealth, in 6 months, 12 months, you know, 24 months time, will we go back to normal, and will they go back to kind of where they were 6 months ago?
Yeah, not to hog the questions, but I'm happy to take that one as well. I think it's listen, predicting that is difficult and it's sort of somewhat unknowable. But if you think, for example, in the telemedicine space, you know, 3 months ago, 90% of consults probably happened in person, and, you know, anecdotally 10% would be remote, and that's completely flipped, right? And I think as we've all faced personal dislocation and sort of a changing environment personally, and have generally had an open-mindedness or a willingness to change practice and adopt new technology, my expectation is that a big chunk of those you know, new customers that have changed the way they experience a service or a product would have had a good experience and had a good outcome by virtue of the new technology. And, you know, I don't expect it to retain at the same levels that we're seeing sort of today in the long term, but certainly I wouldn't expect it to flip back to how it was. So I think, you know, a lot of people are talking about establishing a new normal across a whole bunch of industries and technologies. And that's certainly something that, you know, we see playing out.
Yeah. Let's talk about the new normal. Ellisa, I was going to ask you, you know, a lot of VCs are really upfront with startups about what their process is, what they're looking for. And, you know, I know Blackbird publishes those processes. It's very public on what you go through when you're deciding on an investment. Has anything changed for you guys fundamentally in that process? Or are you operating exactly the same today as you were 6 months ago?
I don't think the sort of values that we go by or what we look for in founders have changed. Perhaps maybe there's been a bit of a shift in the way we look at different sectors, and going back to what we were saying earlier with telehealth, yes, there's more opportunity in telehealth, but I also think it's dangerous to paint a broad brush across a sector. It really depends what you are doing in telehealth. There are a lot of telehealth businesses that will actually suffer from this because the government has adopted, just become more conducive to telehealth and to GPs working through telehealth. So some businesses will actually suffer even though their headline is telehealth.
Let's just touch, you touched on the government, and I did want to get, you know, a broad range of views from you guys on what you think, if any, the government's role should be sort of moving forward from here. That I do get the sense that there's a lot more talk around, you know, innovation and tech and startups kind of being the thing that is going to, you know, help pull Australia back out of recession. It's going to, you know, turbocharge productivity, if you believe that. What Alan, do you think should be the government's role in this? We've obviously seen a lot of stimulus flowing through. Is it money, or are there other things that they should be looking at doing, you know, really quick, smart, to help tech, I guess, get us out of this? You're on mute.
Beg your pardon. I think.
How many times have I said that in the past 3 months? You're on mute.
My next T-shirt is actually going to be "You're on mute." I think we've all paid a lot of attention to government spending on stimulus measures to individuals, and also obviously the COVID Safe app, and whether that was great or not. And I would like to see, most of the work done behind the COVID Safe app was done by private sector, but largely was done by large, safe, trusted government contractors. I would love to see government at local, state and federal levels start to live up to that promise that they were going to start buying from startups. To become a customer of a startup would be the best possible way the government could help the startup industry right now. The second thing that I would love to see change is a changed attitude towards research and development. So I think we currently have a government with a minister who thinks that the R&D tax concession was a rort. That was somehow protecting this industry that was a friend of government. I don't know where that came from, but the R&D tax concessions or other ways of fostering the growth of R&D in Australia are essential to provide the smart economy that we want to see. We need to give individuals, small enterprises and large enterprises financial motivation to invest in research and development. It doesn't have to come out of a university lab to be R&D. And the smarter and leaner it is, the more prepared we should be to back that. We will make mistakes sometimes with taxpayers' dollars, but that's an accepted risk. Every time we give people $25,000 to spend on renovating their house, there's a risk that there will be some misuse of those funds. For some reason, it's only when the risk that we might be have our motivations wrong when it's addressing the startup industry stimulus that it becomes a reason not to do it.
Emily, is the R&D thing, I saw you nodding, would that be your sort of number one preference?
Yeah, absolutely. I would also say that the JobKeeper has been a lifeline for the startup industry, and it's been incredibly important to help startups navigate this turbulent and sort of uncertain time. However, we've definitely been working hard with companies in order to ensure that they use that time wisely to make sure they can stand on their own 2 feet going forward. However, the government should now be helping companies move from survival mode into sort of thrive mode. And as Alan suggested, I think potentially bringing forward the sort of R&D payments that the governments will typically make around September. If you maybe brought those forward so companies could access them now and invest in product. And we often have been saying to companies during this time that cut fat, so cut unnecessary expenses, but don't cut investing in the muscle, which we believe is product, because that's the reason that your customers buy what you're selling, and that's the reason why customers love you, is because of the product that you're building that makes their lives easier. And so R&D is incredibly important to that, and I think that potentially bringing payments forward and potentially making it a lot clearer as to how startups can access the program would be really helpful way for the government to help startups move from survival to thrive mode.
Yeah, it is terrifying though. I mean, technically I'm running a startup, and I know, all you want to do is just take the cash that you've got and hold on to it super tightly.
Yeah.
And not spend it on anything because it is so uncertain. And I think that, that is going to make for any startup, regardless of whether you've got $3 billion in the bank or, $30, just into, how do you work, I guess, with your portfolio companies to get them through that, to get them feeling like that making that investment is actually a good idea and will help them grow.
So I think 2 things. Firstly, we have done a lot of planning with our portfolio companies, and often, sort of the reward of planning is just feeling prepared. It's not often that the plans play out the way that you think, but essentially what that's helped our portfolio to do is really to understand what triggers they're looking for in order to double down on investment again. So what triggers are they looking for to see whether it's a good time to be investing in, experimenting or starting to invest again in kind of sales and marketing, or sort of what experiments should they be running with customers to feel comfortable they should be making that investment in their product. So doing a lot of planning up front in this uncertain time has been incredibly helpful to sort of help our startups to sort of double down on certain areas. The second bit that we definitely have seen in our portfolio, and it's been incredibly sort of heartwarming to see, is that we've invested in teams that really sort of fly in the face of sort of adversity. Like the companies, the founders that we're investing in are incredibly resilient. you sort of, at this time, we definitely believe in the entrepreneurial spirit, and the teams that we're backing have just been so sort of proud of to be sort of sitting alongside in terms of how they've rallied around their teams and how they've rallied around their customers and making sure that they're still, like I said earlier, being there for them and sort of remaining mission critical. So I think those are two things. We're sort of investing in teams that really thrive in this environment, and secondly, we've done a lot of planning up front to help them know where to sort of invest.
Yeah, it's interesting you mentioned that, Justin. It'd be good to get your view, sort of where you see Australia sitting in a global perspective. Obviously, from the health perspective, we've managed to come out of, fingers crossed, COVID-19 really well. How do you see that sort of entrepreneurial spirit and the robustness of the Australian startup ecosystem? And I asked that because I was talking the other week to Jason Calacanis, and he was saying, what he sees here compared to what he sees in Silicon Valley, he thinks Australian founders are more resilient, and that they just work harder.
Yeah, it's interesting. I'm sort of not the psychology expert nor the sort of global macroeconomic expert. But,
have a stab anyway.
But no. I think it's fair, and I think Australian startups are sort of world renowned for resilience, and probably the other factor is capital efficiency. By virtue of sort of a long history of a venture community that's been sort of undercapitalized, Australian companies are used to bootstrapping, and a lot of our businesses, to be honest, go down that sort of growth path of fairly profitable, certainly sort of strong underlying unit economics around their business, as compared to some of the US playbooks we've seen recently, particularly the likes of SoftBank and other sort of much larger growth stage capital funds, where effectively growing the top line often at the expense of sort of sound economic models. And I think, Australian founders certainly have a reputation for that. When we've taken founders over to the US to raise follow-on rounds out of there, they're often astounded by the efficiency and the levels that Aussie founders are able to get to without that capital base. So I think that's certainly true, and that probably serves, our local ecosystem pretty well. Maybe the other thing just to mention, it's the Australian venture community has sort of grown up in the last 5 years, if you like. And the level of dry powder that's been raised locally and globally, to be honest, but particularly locally, is significant. And there is now, a good capital base. I think there should be more, to be honest, but there still is a good capital base supporting local founders. And, it's probably never been a better time to start a business locally with the capital base that's behind you. So at least from my perspective, I'm feeling a little bit optimistic about the Australian startup ecosystem in FY21, and hopefully there's a good opportunity for founders to at least raise capital and build a business at this time.
Yeah, I would actually like to get, Justin, I'll come back to you, and then I'd like to get a view just quickly from all of you on this, on the sort of the capital landscape, because it's been really interesting to me watching what's been happening on public markets. The ASX back up now where it was, just before COVID hit. Multiples in the US are, some would say, somewhat crazy. Are you seeing though, and I think a lot of that argument is around just weight of money. You can't put money in a bank and make money on it anymore. So people are prepared, I think, to take a bit more risk, and they're looking at other asset classes. Are you seeing, new capital flowing into this sector as a result of that?
I would say that the private markets that we operate in are fairly uncorrelated to public equities in many ways, to be honest. Some of it does filter down, but the recent rally in public equities is quite astounding, to be honest. And we're certainly not seeing that in our worlds. Anecdotally, one of the biggest accelerators in the world, Y Combinator in the US, they just sort of ran another cohort of startups, and valuations across the board were down by about 36% on average.
Yeah.
So I think if anything in our sort of private markets, you've seen a bit of a pullback from venture funds looking to support existing portfolio companies, still allocating and still good dry powder to deploy and commitments to meet. But I think if anything, certainly going forward over the medium term, liquidity in the private markets, will be a little tougher. I think the other thing to watch out for is, venture funds raise the next vintage every 2 to 3 years. So it really sort of depends where they're up to in the cycle of raising their next sort of fund. And I think there'll be a bit of a lag. We saw that in the GFC. There was sort of a 12-month lag until some of the public equity sort of dislocation really hit the private venture market in earnest. So I think, I'm not really seeing the same levels of rally that we're seeing sort of in global stock markets. And if anything, I think there'll be a bit of a lag until we see the full impacts on the venture community.
Yeah, Ellisa, what about you?
Yeah, so I think similar to what Justin was saying, there probably will be a bit of a 12-month lag, particularly because a lot of VC money in Australia comes from the Australian super funds, who have taken a particularly large beating lately. So that sort of lag could come through. But yeah, it still remains to be seen how large their liquidity issues actually are. It's looking a little bit more positive than we expected. So hopefully it is.
Alan?
The thing with the public markets is that people make money if the market goes up or the market goes down. In fact, unless the market is going up or down, nobody's making money, right? So just because the market's gone back up to where it was doesn't necessarily mean that everybody's confident about the future. It just means that everybody still has to make money. In private markets, it's different. Unless the valuations go up, we don't make money. So that's why I think there's very little correlation between the private and the public market. I think what concerns me is that our oldest and strongest vintage of Australian tech venture funds is up for winding up in the next couple of years. And I would hate for valuations of some of the leading companies in those funds to be affected by this pandemic when it's time for the fund manager to exit from those holdings, because that would be a real downer for another whole generation of Australian tech venture. Like prior to this sort of 2010, 2014 era of funds, Australia didn't really have tech venture capital. Not great, not successful, mostly looking offshore for deals. And so it's AirTree, it's Blackbird, it's Rampersand, it's that generation of fund manager in Australia who really need to succeed with their first funds. They've looked tremendously strong all the way through their history so far. And as an LP and Blackbird's 2012 fund, I'm watching that one closely. So I think there's tremendous opportunity there, and I'm not concerned at this stage. But our whole industry is counting on that vintage of funds doing very well. At the moment, they're world leading. I hope that will continue.
Emily, what would you, on this topic, what would you kind of say to founders that they need to understand about what the sort of capital flows and what the landscape looks like at the moment, if it is any different to what it looked like 6 months ago?
So I'd say at the moment there's still a lot of dry powder in venture capital and dry powder in Australia. We raised our third 275 million fund in October last year, so we have lots of capital to deploy, and we're investing with the same cadence, so the same pace. Since last year, we've issued 3 term sheets and on the same terms that weren't changed in this new environment. And I think I'd say to founders, really at the early stage, valuation is so much more driven by team and the market opportunity than it is by public comps. And I think that what we're really focusing on more probably at the early stage is just ensuring that companies have a long runway. And the reason why we want to do that is we want to give companies enough time to be able to invest in their product and have proof points that set them up well to raise in the next round. So that's kind of where we're focusing more at the early stage. And I think at the later stage, I think that's when potentially your valuations can be sort of a little bit more influenced by public market comps. But, and at the later stage, I suppose we're sort of spending a little bit more time on what Justin actually alluded to. And one of the early questions is to weather sort of a more turbulent, time, we're looking for sort of companies that actually are able to switch into more profitable growth. And so we're looking for companies that sort of are able to acquire more revenue and spend less than they did in the previous quarter. So actually being able to sort of change that kind of, that growth trajectory of those growth channels. And the second thing we're looking for, probably a bit closer in that later stage, is we're looking at companies that really have strong product market fit. And how I think about that is actually have, you know, they've got customers that love their product, because at the moment retention is key. You don't want to have sort of a leaky bucket syndrome where you've really invested in acquiring companies and they're dropping out the bottom. So at the moment, I think in that later stage in particular, sort of retention is key. And I think we always say to companies, the best time to raise is when you're coming from a place of strength. And I think that at the moment, I would say strength is very much in terms of, when I think about strength, it's about customers. So it's about customer engagement, customer usage, you know, acquiring, you know, key customers. So if that's still happening, I think then you know, it's a good time to raise.
Okay. We don't have very much longer, and I do want to do another whip around at the end with another question, but I'm just wondering if anyone wants to put their hand up and take this one, and that's around whether you're seeing more interest from investors around, I guess, the values that startups hold, and startups that people see would be making sort of a positive social impact as a result of, you know, I guess the turbulent times that we've been through.
I'm happy to take that one. Yeah, I think the short answer is yes. We're seeing more and more interest in it every year. And I actually think it's great. ESG is going to have a very large impact on companies in the longer term as to how successful they are anyway. So focusing on ESG now and early kind of just sets you up for the future and hopefully faster and larger growth.
Cool. Okay, we do have to wind up soon, but I did want to ask each of you just to finish on a positive note. Just give me a short answer on what you're looking forward to in FY21, which is just weeks away, Alan.
I'm looking forward. I had my first face-to-face meeting with the team in an accelerator program yesterday, and I'm really looking forward to having more face-to-face meetings with people. I'm a big hugger. It'll be a while before I can hug my friends and colleagues again, but I'm very much looking forward to that. But I think because Australia breeds resilient startups that are capital efficient, as the global economy comes out of this recession, it's going to be a tremendous opportunity, and most of our companies will be in a stronger position. And so I'm looking forward to being, you know, a champion of some of those companies and helping them take the world by storm.
Awesome. Justin?
Yeah, it's a similar vein. Obviously, looking forward to going back to the pub. But I think, you know, a lot has been written about it being a good time to start a new business. And I'm looking forward to sort of a new wave of Aussie entrepreneurs, hopefully following in the footsteps of your SiteMinders, Deputies, Atlassians. And hopefully, you know, we get to partner with the next batch of exceptional Aussie companies in FY21.
Ellisa?
Yeah, I'm really looking forward to seeing what emerges out of this whole period that isn't as obvious, like not telehealth, not cybersecurity. What will be super obvious in hindsight, but nobody's talking about it yet? And who is that person that's passionately beavering away on some massive solution that we don't even know about yet? I'm sure something will come out of this, and I'm really excited to see what it is.
Emily, what are you looking forward to?
There's been a lot of talk about how COVID has been sort of a common enemy across the globe, and how people hope that potentially it's a forcing function for some of the changes that we've been wanting to see across society. And I think that for me, that sort of feels like things like modernising government and healthcare and education. So it's like lower cost and more efficient for people, and potentially as workforce changes, maybe ways in which people can kind of get back into jobs that they actually like and are more sort of suited to their own skills. And then potentially another way people are thinking that this might affect change is people being more conscious consumers, and then actually, you know, potentially bolstering that kind of community and neighborhood and connections across sort of family and sort of. So I think this question is coming as, could it be a forcing change for good? And the question is, can technology also play a role in enabling that change? And I think, as you know, as investors, AirTree would love to partner with companies that are potentially having that really positive impact on society.
Well, they are some very high hopes. All of you, it was great to talk. It was great to meet you all. Thank you so much for your time. We'll catch up again soon.
Thank you.
Thanks, Kylie.
Bye.
Bye.
Thank you very much to the panelists. I hope you enjoyed Capital 2020. For me and our team, this was something that we were inspired to put on for you, our ecosystem and our network. I would also like to say a big thank you to our team. People do not see how hard we work and how much coordination it takes to bring this together. To have over 15 companies, to have over Australia's top VCs, and to have over a leading entrepreneur and investment sort of thinker in this area, all within one jam-packed session, is an incredible feat to pull off in a short period of time. For me, going forward, I want you to obviously like what we're doing on the YouTube stream, engage with the companies. I said if you found interest in the companies that presented, or if they're relevant to an investor, another high net worth in your network, invite them to the stream, invite them to view the content that you just viewed, let them know about it. This is how we actually build our ecosystem. I thank you very much for joining. I hope you enjoyed the Capital 2020 conference. We look forward to delivering you many more.
Bye.